Okay, good morning. Good morning, guys. Good morning, online people. Are you there? How are you doing? Come. Yes, good morning, all of you. Let's begin. Yes, can you hear me, online people? Good morning. Yes, all good. Can you hear me? Cool. That's great. Let's begin, guys. So today we will be starting off with capital gains. Right. So capital gains will do, and yeah. So the next class we can either do tomorrow. We'll see because there's some band and all tomorrow. Problem is I had some corporate workshop to handle. If that gets cancelled, then tomorrow we can do. If you guys cannot come, then maybe you can take it online only. You can come, great. I'll let you know. Tomorrow is some band apparently. Metro will be working. Other things will not be working, like your auto, all that will not come. From Mantri Mall, it's some 7 minutes walk. That's all, actually. Okay, guys. Anyway, I'll let you know about it. I don't know. See, if tomorrow is a bun, then I have a corporate workshop tomorrow to handle. If the office is closed, then I'll be free tomorrow so that I can take it. And that workshop will be shifted to like Wednesday and Friday. Otherwise, if the workshop is gonna go as planned, then cool, we'll meet on Friday, because till Friday I'm held up with those things only. Cool, guys. Let's begin. The capital gains. Either way, I will let you know on the groups, so no tension. But today will happen for sure. It's already happening. Yes. So income from capital gains, 6 to 10 marks easily it will come in the examination. Very, very important chapter. So let's go. It's as important as PGVP, to be honest. So this is also very important. Let's begin. So what do you mean by a capital? So basically in this entire chapter, we need to understand what is a capital asset. What do you mean by a transfer? And what is FVOC, full value of consideration? So what is capital asset is one. What is transfer? What is that full value of consideration? So we need to categorize whether an asset is capital asset or not capital asset. And we need to see whether it is transfer or not a transfer. And third one, when you transfer something, you'll get money. And what is that money? FVOC, full value of consideration. And after I subtract the expenses, whatever I get would be capital gain. Now that capital gain will be liable to tax. At certain rates. So what rates we will have to see. And there will be type of the capital gain is short term or long term. This is purely based on something called POH. POH means period of holding. So based on the period of holding, whether it is long term, short term, everything will come. So that's what it is. So rates will be depending on many things, and based on the type of gain, short term, long term, and then POH is the period of holding. So again I repeat, capital asset, transfer, FVOC, and expenses, capital gain will come, and that capital gain will be taxed at certain rates. Now tax will be based on the type of capital gain. It can be short term capital gain or long term capital gain, and also there will be something called POH, that is period of holding, and rates will be given as it is. Now 45(1) of the income tax law clearly tells when the capital gain will be taxed. Now today if I sell it and I get some money, will it be taxed today? Or I sell it today, I get money 2 years later, will it be taxed that time? For example, if any land has been compulsorily acquired by someone, by government will not pay you money today. Government will pay you 2 years later. So when is the gain taxed? They will fix that 1 crore I'll pay you. So should I, without receiving any money, pay tax today, or should I pay tax later? All that we will see. But generally, like for example, if a land is sold not to the government, but land is sold to somebody, or not land, let me take an example of building. A building is sold to somebody. When a building is sold to somebody, then that gain that you get, will it be taxed that time only, or will it be taxed when you receive the money? So I'm not talking about compulsory acquisition, etc. I'm just talking about any building. Building when it is sold. This is the year of transfer. This is the year when my ownership has been transferred to you. I'm getting money. So is it tax in the year of transfer or is it tax in the year of receipt of money? So general rule under 45(1), any gain or profit arising from transfer of a capital asset shall be taxable. Shall be means mandatory. Shall be taxable under the head capital gains in the year in which transfer takes place. In the year in which transfer takes place means the year in which the ownership is transferred to the other person, that is the year of taxation. Money I have not received, I don't care. It is in the year in which the transfer takes place. But there are exceptions to this rule. Those exceptions you will see later. So we need to understand what is transfer and we need to understand what exactly is a capital asset. So to understand what is capital asset, we'll have to go to 2 clause 14. So capital asset means, so whenever the act uses the word means, it is an exhaustive definition. No other meaning can be given apart from what is given here. So capital gain means property or means property, capital asset basically, capital asset. So this definition is about capital asset. So if you see transfer of a capital asset. So what is capital asset? When you transfer capital asset, you will either get a gain or you will get a loss. What is a capital asset? Means a property of any kind. So the moment you use the word any kind, it can be movable, immovable, tangible, intangible. Tangible, something that can be seen, intangible, that cannot be seen. Yes, like, copyright, trademark, etc. We'll see that. Held by the SSE. Whether connected to business or not, I don't care whether it is connected to business, but excludes what? Stock in trade. Because stock in trade will directly go to PGBP. So basically, if I have a stock of 10 phones, though not for personal purposes, but okay, let's take work laptops. So let's take jewelry. So though jewelry I am into jewelry business, though I have around 1 crore worth of jewelry, that is actually a capital asset, but since I'm using it in business, they have excluded it. It says stock in trade. So if I use laptop or if I use jewelry, etc. as a stock, then definitely PGBP will come, capital gain will not come. Next, movable personal assets are not capital assets. So mobile phone, which you use for personal purposes, mobile, fridge, your chappal, all these things will not be capital asset. Obviously, imagine if I sell my chappal, like actually these people sell, no, in auction they sell. Some actor recently sold his belt for some 6 crore. Imagine, crazy man. So, and Diana, Princess Diana, her sweater got sold for 16.3 crore. I'm not joking. Just recently, you can check the news. Her sweaters, which she was using that time, of course, many years ago, right? If we and all have to sell, you only have to pay. You pay, you please take. Yes. So movable personal asset, like Mickey Mouse drawing and all. If I draw, you see, except what? Jewelry, drawings, paintings, sculpture, archaeological collection. So artwork is definitely capital asset. So recently one painting which was bought by somebody for 350 rupees sold for 20 crore. Somebody saw a painting bought for 350 bucks and he sold for 20 crore because it turned out to be some great artist's painting. So paintings also, if you see these modern art, on some canvas, they'll put some 5 lines. That's it. That meaning, when you see, you can give so many meanings you can give that. So if you see, yes, so those, of course, the artists, many artists are there. M.F. Hussain was one artist who used to be there. Then Yusuf Farakal of Kerala. They mint money. One painting goes for 3 crore, 4 crore, like that. So, except jewelry, drawings, paintings, sculptures, archaeological collection, or any other piece of art, right? So these things are not what? Though they are used for personal purposes, they are deemed to be capital asset. So mobile phone, fridge, chappal, etc. are definitely movable personal assets, so it is not capital asset. But jewelry, drawing, painting, sculpture, any archaeological collection, etc., any other piece of art, that would be definitely capital asset. So if during archaeology you will find somebody's clothing or somebody's sword, etc., yes, all these will be examples of what? Definitely capital asset. And that if it is sold in an auction, that would be capital asset. Somebody bought Shivaji Maharaj's sword recently for some 20 crore. That definitely is an archaeological collection. So that is a capital asset. Yes, so jewelry, diamond, platinum, ruby, and all these things definitely is a capital asset. What about utensils? Normal utensil, right? Utensils, if you I mean, habit of steel, etc. They are all personal assets. So we have in our homes all this steel, aluminum stuff, steel stuff. Yes. Silver. Though silver has jewelry, actually it is what? It is, what do you say, capital asset because it is jewelry. But the Supreme Court has told many silver, stuff that you have from your legal heirs, from your great grandmother's one silver, plate will be there. Now you don't have money, you want to sell it off. Now is that capital asset? So the income tax department told yes it was capital asset. They are 100% right. But the issue went to Supreme Court. They said it's okay. Some exceptions have to be made. The intention of lawmaker was not to tax everything. So they said silver utensils are deemed to be personal effects as per a Supreme Court judgment. But what about gold? Gold is always a capital asset. Then you would have seen some people wearing. I just came back from Indore. Night I went there to a night market, food market. So there I saw one politician had come that day. So that politician, I could recognize him, identify him only because of the gold he was wearing. Everywhere gold. Here rings everywhere gold. Because some free campaigning he was doing, he was giving kulfi to everybody. So he was selling, not even selling, giving free kulfi. Two politicians, the media people and all were there. So full gold, adorned in gold, right? So that, and some people would have, had gold garments also. Entire garment will be made of gold. So that, person, all these things. There's a musician called Bappi Lahiri. Bappi Lahiri was, it's like, if he got kidnapped, it's like an entire jewelry shop got kidnapped. It's like that. Always wearing jewels. He passed away. Very famous singer, musician. Yes. So anything sewn into the garment, your gold phone. In Dubai, you have gold toilet and all. Imagine. All these are what? Capital asset. So gold studded watch, gold studded everything. These are all will be capital assets. But of course, silver stuff is not. What about your car? You have a BMW car of 1.5 crore. Doesn't matter. So though it doesn't matter how much you're paying for the car, it is used for personal purposes. But if the BMW is used in the business, then it will be added to the block. So still, it will be a capital asset added to the block. TGBP it will go. It will not come under capital asset. So any car also, if you have a heavy duty car also, my dear friends, it is always what? Not capital asset. It's personal effect. So these are all the things. So excludes what? Stock in trade, mobile personal assets. Third one, rural agricultural land in India, mind you. Rural agricultural land outside India, definitely capital asset. Rural agriculture, urban agricultural land in India, capital asset. Rural agricultural land outside India is capital asset. Urban agricultural land in India is capital asset. Rural agricultural land in India is not a capital asset. Now, what do you mean by agricultural land? Very simple. So if you see here, if the population, we have discussed this, I think, again I'll revise. If the population is less than or equal to 10,000 rupees, then it is urban or rural? Rural. If the population is more than 10,000, but up to 1 lakh, so up to 2 kilometers, within 2 kilometers it will be urban. Beyond 2 kilometers if there is a land, then it is rural area. Similarly, if the population is more than 1 lakh, but up to 10 lakhs, more than 1 lakh, but up to 10 lakhs, then in that case, up to 6 kilometers it will be urban. Beyond 6 kilometers it will be rural area. More than 10 lakh rupees if it is there. More than 10 lakh rupees if it is there, then what is the scene? Then up to 8 kilometers, what is it called? Up to 8 kilometers, what is it called? Rural area. Sorry, up to 8 kilometers, urban area. Beyond 8 kilometers, rural area. So here, one plot of land, if it is here, assuming population is more than 10 lakhs, one plot of land is here. Is it beyond 8 kilometers? Yes. So this will be called as rural agricultural land. So up to within 8 kilometers, urban land. Beyond 8 kilometers, rural land. But now with the advent of so much commercialization and technology and also rapid population, etc., rural lands are very rare for you to get. Everything will be urban area only. But again, what is this urban rural? Where from where? There will be a cantonment or the jurisdiction. The cantonment board or area, they will decide. So basically your registrar's office, they will decide what is the radius, etc. So everything is legalized. You can't just say, according to me, this is 6 kilometers. No. And this kilometers and all is based on what? It is the aerial view. It is the aerial view. Not, if there are long winding roads and all that, you cannot take that as 6 kilometers. It's the aerial 6 kilometers. So actually, if it's long winding roads, it can be 12 kilometers also. But aerially, it should be 8 kilometers, 6 kilometers, like that. That is what you need to keep in mind. So this also is not a capital asset. Rural agricultural land in India is not a capital asset. Definitely they are not capital assets. Then there were gold bonds under 1999 by Yashwant Sinha, and after that recently during gold monetization scheme of 2015, Arun Jaitley also released it. This is what, if you have gold with you, you can give it to the government will melt it and make it into a solid ISO certified coin, and based on the power of that coin, they will actually give you some money. Actually, it's like selling the gold, but they said no problem. With that gold, what will the government do? They will keep it in as reserves, gold reserves, and on that security, they can take loan from International Monetary Fund and all those things. So it's a win-win situation for everybody. They say, since I don't have so much gold, I'll ask gold from you only. I will convert it, melt it off everything, and then I will give you a solid coin. After many years, when you repay, when I'm paying you back that, I will pay you in that coin. So if you're ready for that, then go with the gold monetization scheme. So even though it is 100% capital asset, government only is giving specific exemption, saying it is not exemption, it is non-applicability. It's not at all applicable. So they say gold monetization scheme and gold bonds are not capital assets. Then of course, these foreigners, when they were investing in India, when they were buying, selling in India, obviously they're using it as stock in trade, buying and selling of shares when they're investing. So foreign institutional investors are investing a lot of money in India through buying shares, etc. When they're buying, selling shares, obviously it's PGBP. So the assessing officers were charging 40%. They went to the government and said, boss, first of all, I'm coming to your country. When I'm coming to your country, I'm using your country and I'm helping your country only for the increasing GDP, etc. If I do short-term and long-term capital gain, it will be 15%, 10%, etc. But now under this PGBP rule, it is 40%. I will not come. So to sort of help them, to calm them down, government excluded whatever trading done by foreign institutional investors as not capital asset or capital asset. What? Here you see. What is this? Is it covered or not covered? But does not include. But does not include these things. So if you see here, what did they say? Here you see. Any securities held by a foreign institutional investor which has invested in such securities in accordance with SEBI regulations. So if it is a short-term capital gain, I should charge at the normal rates, right? But can they take benefit of 10-15%? Yeah, they can. But the thing is, if it is as stock in trade PGBP, they can claim many things. So initially they should charge 40%. But then here also under capital gain, if you see 10-15% if they take, they will not get any other benefits also. Right? Direct rate it is. But these people used to pump in so much money and they used to have a lot of, things. So you see, is this capital asset or not capital asset? Tell me. Now tell me. Is it capital asset or not capital asset? What is better? Okay, expenses I will claim, but still I have to pay how much tax? 40%. But if it is a capital asset, how much tax I'll pay? Just 15% or 10%. So when they did the calculation, even if I subtract all the expenses also, 40% was still a higher tax. Whereas if it is a capital asset, it will be lesser tax. So after doing all that, what is the calculation? They went to the ministry and said, boss, look, I am pumping in a lot of money to you and I will stand by the whatever I told you that time also. They told, I needed it as a capital asset because some assessing officers are making it PGBP. But you cannot tell me and say, sir, but if you show expenses, it will be less PGBP. So they did that calculation also. And they finally said, now you want me to come to your country or not? Yes, sir, I want you to come. Then decently, whatever securities I am trading in, holding it, please make it a capital asset. So it does not include only ABCD. So this dialogue here does not include this one, does not include only ABCD. But other things are definitely what? Capital asset. This point number small b, small c is what is capital asset. What is capital asset? Foreign institutional investors, capital asset for sure. Because now they said, I don't want under PGBP, I will not get any deduction. I will not be able to make any money. Please make it as capital gain only. It's okay if I don't get any other deduction, etc. But it's just 10% and 15%. And then after selling these things also, I will get exemption under section 54. I can claim some exemptions under 54. So it's fine. I will go by this only. I don't want your PGBP. So they said, okay, capital asset. Next, unit linked insurance policy to which exemption under 1010D doesn't apply. So we'll see that later. So there If a person has subscribed to a ULIP, that is unit linked insurance plan, and the aggregate of premium paid on all the policies exceeds 2,50,000 in any previous year, exemption under 1010D will be denied. Exemptions will be denied. So if the exemption is denied, that part will be called as capital asset. So when you sell that ULIP, since it is linked to the market, it is like holding a long-term capital asset only. It is like holding shares. That's the reason why they have made it a capital asset. So what is capital asset? All this jewelry and all those things are capital asset. Only personal effects are not capital asset. Jewelry, archaeological creation, painting and all are capital asset. And securities held by foreign institutional investors are capitalized. ULIP, for which 1010D will not apply, will be a capital asset. Then your urban agricultural land is a capital asset. Rural land outside India is a capital asset. So that is the definition of capital asset. Beyond this, nothing is there, because 2 clause 14 says it means a property of any kind. And what that any kind we have seen now. That is one part of the story. Then it includes, excludes. Then we have to understand what do you mean by a transfer. Transfer means what? One, sale of capital asset is a transfer. Because capital gain will come only on the transfer of a capital asset. So what is sale of capital asset? It is definitely transfer. Next, exchange of capital asset, that is also transfer. Exchange means what? One asset I will give, another asset I will take. That is also transfer. So if I give an asset worth 1 crore and take back an asset worth 1.2 crore, definitely it is a transfer. Third one, relinquishment and extinguishment. Relinquishment means surrendering. Extinguishment means where your right is exhausted. For example, in 2020, Reliance issued right shares. For every 15 shares that you held, you can buy 1 right shares. So I had, let's say, assume if I had some 1 lakh or 1,50,000 shares, I can buy some 1,500 shares odd. So now the question is, if I had 1,50,000 shares, correct, I can buy so many shares. Now the thing is, I don't want to buy, but I have the right to buy. That right, can I sell it to somebody? Yes. When I sell off that right to somebody, what am I doing? Relinquishing the right. The right that I've got free or not? Yes, I've got free. But what should be my underlying thing? I should only hold some assets. What do I hold? I already hold. So let's assume if I have 15,000 shares, for every 1 share means 1,000 shares I can buy 1,000. I have the right to buy 1,000 right shares. But I don't want to buy now. What will I do? I will sell this right at 40 rupees per right. 40,000 rupees I make. Is it not taxable? No, it is taxable, because it will be relinquishment of a right. Because capital asset can be a right also, we saw, tangible or intangible. So everything will be taxed undoubtedly. Definitely you will tax. Next, this we saw conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. The reverse we had seen in PGBP. We had seen Shobha developers, they had capital asset, they converted it into stock in trade. Then PGBP will come. This is reverse. I already had a capital asset. Now I converted into stock in trade. So I had lot of jewelry. Now I brought that jewelry into business, into stock in trade. So jewelry, capital asset, I had cost of 1 crore. I transferred it to stock in trade. FMB as on the rate of transfer was 2 CR. So is that a transfer? Yes. Is that a transfer? Very much yes. So conversion of capital asset into stock in trade will be what? Capital asset. Next, compulsory acquisition of a capital asset. Due to metro construction, one part of your entire area, you have a land, you have building, they will demolish it and construct. It happened in Bangalore, many places. They will construct what? Metro. So that time government will compulsorily acquire the land from you. When they compulsorily acquire the land from you, then what will happen? They'll have to pay you compensation. Is that compensation? Is that transferring the land forcefully? Is it also transfer of capital asset? Yes. If this dialogue was not there, people would have gone to court and said coercion. Under Contract Act, coercion is voidable. Voidable, you can cancel. They'll say, I can cancel the contract. No. So this overrides Contract Act. Specific law overrides general law, Contract Act. So here the answer is what? Is it a transfer? Yes. Next, allowing possession of immovable property. This we had seen deemed owner concept. So if I, what do you say, it's deemed owner, whereby in that we had not seen the deemed owner concept that time. Here it is slightly, we had not done it there because I want to do it here. There, deemed owner in house property, what did we do? Deemed owner is the husband has 4 houses. 2 houses will give it in the name of the wife. That is deemed owner for house property. In deemed owner point, one more point is there. This is, I am buying a house. So when is the house deemed to be bought? Or you are selling the house to me? You are selling the house to me. When is it transferred is the question. Should I register in my name, date of registration, or when you give me the possession, or when? You may give the possession today, but registration can happen 2 months later. Or you may register today, but the possession can be later. So either way, here, many cases what happens, possession will happen first. After that, registration. If you buy a house, very simple, they'll give you the key. So you do whatever you want, interior you want, get it done. When is the transfer happening? That's the best part. So as per the Transfer of Property Act, transfer will happen when you allow the possession of the immovable property. When is transferring happening? Allowing possession of immovable property, though the person who has bought the house is still not an owner. When will be a real owner? Registration. But still is deemed to be an owner, and hence it is transfer. That is this point. As per Transfer of Property Act. So legally, definitely on the date of registration, no doubt about it. But as per law, when the transfer possession has been transferred as per the year 17 September, like that. Similarly, transfer of shares of any cooperative society is also a transfer. So those of you living in apartments, you should understand what is the association, how is it made. It is made as an association of person, which means it's a cooperative society. Who owns the house? You own the house or cooperative society? Cooperative society owns the house. The entire building cooperative society owns. What do you own then? Shares. Shares in that cooperative society. Tomorrow when you are selling these shares to the outside, so somebody else wants to buy the house. He will not buy the house. He will buy your share in the house. Share in the entire society. So your share will be the entire house plus something called common area. Something called common area. Undivided share of land. Correct? Undivided share. Generally it's called UDS. Undivided share. Which means in the common area, park, etc., swimming pool of the building, I am the owner. One small fragment, I will be the owner. Everything will be represented in the form of shares. And shares will be given to whom? The owner. So now the question is, if I own the shares and I transfer the shares to you, is that deemed to be transfer? Yes. If I transfer the shares of cooperative society, it's like I'm transferring the entire house which belongs in that cooperative society. Then zero coupon bonds also, if 70 rupees bond is redeemed at 100 and the 30 rupees is called capital gain, because I am getting the money. How much I am getting? 100 rupees. So out of 30 rupees, how much I have to pay? 100. 70 rupees is the issue price, 100 is the redemption price. So that is also deemed to be transfer. So we understood what is transfer. Online people, are you understanding? We understood what is transfer and then we understood what is capital asset. Now we have to understand the transfer of capital asset and various types of capital asset. That is, what is short term, what is long term. Some assets are called short term, some assets are long term. So for this is a very important chart which we have to remember. So what is it? Any security other than the units. Units means what? Units of mutual fund, etc. Any security listed in a recognized stock exchange in India. Any security listed in a recognized stock exchange in India. So stock exchange means NSE, BSE in India. Any security other than units listed in a recognized stock exchange in India is what? A type of capital asset. Second, unit of unit trust of India. Units of unit trust of India. Third one, units of equity oriented mutual funds. Units of equity oriented mutual funds. And fourth one is what? ZCB, zero coupon bonds. Zero coupon bonds. The first one, any security other than units listed in a recognized stock exchange, NSE, BSE. Units of unit trust of India. Third one, units of equity oriented mutual funds. And fourth one, ZCB, zero coupon bonds. So all these things, if I sell, the period of holding will just be 1 year. 1 year. So mind you, stock exchange in India. If I purchase anything stock exchange outside India, it will be Not this, it won't come under 1 year. Second one, any immobile property or shares. Shares means what? Equity shares or preferences of a company other than the ones which are covered in Part A. What is covered in Part A, my guys? By my friends, it is listed. So obviously this will be what? Unlisted. Unlisted. For that it will be 2 years. Any other asset apart from this? Any other asset apart from this will be what? 3 years. Any other asset apart from this will be 3 years. So one is 1 year, 2 years, 3 years. So if it is less than or equal to 1, 2, 3, it is short-term capital asset. More than 1, 2, 3, long-term capital asset. So house property, obviously it is immovable property. So 2 years period of holding generally. So less than 2 years, short-term, more than 2 years, long-term. Right? If it's a jewelry, jewelry will not come under 1, 2, 3, 4. It will not come under 1, 2. It comes under other asset. So jewelry will be 3 years. Next, if it is equity shares of Reliance Industries Limited, equity shares is security. Reliance Industries is a listed company. So in a stock exchange in India, well, how much will it be? 1 year. Similarly, preference shares of Infosys. Preference shares of Infosys listed in National Stock Exchange, 1 year. Shares of PJ Private Limited. Since a private limited, what is it? 2 years. 2 years. Unlisted comes under 2 years. So unlisted units of UTI. It says what? Listed. Unlisted units of UTI. Correct? Unlisted units of UTI. Here you see units of UTI. Listed or unlisted, we don't know. Everything is covered under 1 year. So unlisted units of UTI, 1 year or 2 years or 3 years, 1 year. Next examples. Debt-oriented units of Sheila Mutual Fund. Listed where? In Bombay Stock Exchange. Debt-oriented units. No guys, this is what? Equity-oriented units. Units of equity-oriented mutual funds. My example was debt-oriented units. Debt-oriented units will not come under A, will not come under B, then C only. No, preferences of all listed companies cannot be considered as listed. You have to see in the question whether they have given it as listed. Preferences should be listed in the stock exchange, right? Yes. Next. What else? Shares of Tesla Incorporated in the US Stock Exchange. I told you this will come under this because shares of what company other than the one covered in Part A. What is covered in Part A? Only those listed in a recognized stock exchange in India. Right? Anything outside India not be covered. Next. ADR of Infosys Limited is in NASDAQ. American Depository Receipt of Infosys Limited in NASDAQ. So American Depository Receipt is definitely a security, but it is listed not in India, it is listed in New York. Hence, and it is not shares also, mind you. Are you understanding? It's not shares. What is it? It's a depository receipt. So it comes under 3-year category. All these are very important examples. Then, equity oriented mutual fund. Whether it's listed or unlisted will come under 1 year. These are all some of the examples that you need to keep in mind. So anything they can ask you guys, so it is very simple to understand like that. Now, how will you compute capital gain? Very simple. In case of short-term capital gain, it is very simple. Full value of consideration minus transfer expenses, net consideration, cost of acquisition, cost of improvement. That's all. So how do you decide whether it's short-term or long-term? POH, we just did now. 3 years, 2 years, 1 year. So that's how it is. On the other hand, for long-term capital gain, I will have to do one more concept called indexation. Indexation benefit, they will give index cost of acquisition, index cost of improvement. So what is the cost of acquisition for us? For us, how much is it for our year? Finance Act 22. So yes, it is 331. So for ours is Finance Act 22, that is, what is the previous year? Finance Act 22 will be what? Which assessment year? Which previous year? Previous year will be 1st April 22 to 31st March 23. So for that financial year, 331 unit, remember the dialogue. 331 is the indexation that is released by the government. So ICO, index cost of acquisition into index for year of transfer divided by index for year of purchase. Very simple. And cost of improvement, index for the year of transfer divided by index for year of improvement. if the property is acquired before 1/4/2001, because indexation came that time. So the first year, how much is the indexation? 100. Before that, what to do? So they told cost of acquisition or FMV as on 1/4/2001, whichever is higher you should take. Why? Because the indexation concept only came when? Came in 2001. So indexation is nothing but bringing the, what do you say, whatever cost, whatever amount you spent 10 years ago, 15 years ago, I am bringing it to the current rate. And what is the current rate? 331. If I bought it in 2001, the rate was 100. And comparatively, 100 rupees, just a simple example, 100 rupees of 2001 is valued at 331 rupees now, which means what? If I spend 331 rupees now, it's like I would have spent 100 rupees in 2001. That's the level. It is not related to market level, because market may that rate has completely increased. But assume that 23 years ago, if I have spent 331 rupees today, 23 years ago, it would have been like spending 100 rupees. That's the value. So any asset which I bought, I should bring it into current value. But what if I go beyond before 2001? Then the problem is what? I should assume that FMV as on 2001 to be as the cost, because when I take fair market value into consideration, I will consider the market value. So I would have taken into amount the acquisition, the inflation rate, etc. So that's what they are trying to tell. But golmaal was happening. What golmaal was happening? If I had bought in 1990, FMV as on 2001, correct. So FMV means what? Fair market value. Who will do this? Valuation officers. Apart from this, there's one more thing called stamp duty value. Stamp duty value is authorized by the Stamp Valuation Authority, government office. So if I had bought a property for, let us say, around 20 lakhs somewhere in 1980, how, when I have to subtract, and today I am selling it at some rate. If I am selling it at 5 crore today, I have to subtract what? Cost of acquisition. Generally, what should I take? 20 lakh or FMV as on 1st April 2001. Let's say FMV was just around 50 lakh. Stamp duty value also was, let's say, 48 lakh. Now, I don't want this to be 50 lakh because I have to subtract this. More if I subtract, it's better, no? I will go to the valuation officer and tell, sir, I'll pay you 2 lakh rupees. It's in your hand. FMV means you have to sign, that's all. Please make it 70 lakh. Because if you make it 70 lakh, I will decrease my capital gain. And reduce capital gain means I will get some breathing space. So make it what? 70 lakh. It used to happen. It happened till 2020. Stamp duty value was as 48 lakhs. But FMV, because of corruption, 70 lakh. So Nirmala aunty said, hey, cheating. So in 2020, what did she do? So SDV is either called guidance value, circle rate, and all those things. So what did she do? FMB as on 1/4/2001 cannot be more than SDV, where SDV is available. She told that dialogue. FMB of 70 lakh and all you cannot do. It cannot be more than SDV. SDV as on 2001 is available to be what? 48 lakhs. That's it. You cannot go more than that. So what I should do first? FMV as on 1/4/2001 or SDV as on 1/4/2001, whichever is less, I should take. Then that or cost, whichever is high. Simple as that. Cost anyway will be there. That or cost, whichever is high. So this was a big amendment in 2020 because of all the scam people were doing. Correct? They were doing a lot of scams. So no more scams allowed. Yeah, cost of acquisition FMV, whichever is higher. That is what it is. What about cost of improvement? If it is done after 1/4/2001, it's fine. But what if it is done before 1/4/2001? That should be ignored. Why? When I'm doing FMV as on 1/4/2001, anyway, I would have taken the cost of acquisition into consideration. That's how I bring about my fair market value. That's how I bring about fair market value. So cost of asset 10 lakh, FMA is on 1/4/2001 12 lakh. Yes, it will already include cost of improvement anyway. That's what they say. That is the basic calculation and all that. Right. So all this same stuff is here. All this we did. Compulsory acquisition, all that. Long term, short term, done. Computation also we did. Indexation. They will only give all these indexes, don't worry. But we should just remember this 22, 23, 331. Other things they will only give you, nothing to worry. It started off in 2001, 2002 at 100 rupees, 100, not rupees, 100. The indexation was 100. Cost of improvement also same. Right. So I told you there is a scene where generally when is the taxation happening as per 45(1), taxation will happen in the year of transfer. But there are 4 exceptions to it. In these 4 exceptions, it will not happen in the year of transfer. First one, damage or destruction of capital asset. Second one, conversion of capital asset into stock in trade. Third one, compulsory acquisition of capital asset like land, building they will acquire. Fourth one, immovable property transfer in a joint development agreement. In these 4 cases, it will not happen in the year of transfer. It will happen some other time. What is that some other time? We will have to see. So coming to 45.2, that is what? Capital asset converted to stock in trade. So jewelry, if you had at home, cost of 20,000, you transferred as a stock in trade. Ram Jewelers example, right? So previous year 18-19, cost was 20,000, FMV was 60,000. General rule. When is the capital gain calculated? The year of transfer. What is the transfer year? Conversion of capital asset into stock in trade is a transfer. We have already seen it. Conversion of a capital asset into stock in trade is a transfer. Right? So now that stock in trade, ideally speaking, when should I calculate the capital gain? In the previous year, 18-19. I should calculate the capital gain in the previous year, 18-19. But I sell that asset only in previous year, 22-23. I sell that asset in previous year, 22-23. Sold it for how much? 80,000 rupees. So I repeat, cost is 20,000. And when I transfer it, FMA will be what? 60,000. And I sell it where? 80,000. So previous year 1-2, when did I transfer? When do I convert? 18-19. And then when do I sell it off? 22-23. I sell it off in 22-23. So general rule 45.1, capital gain in the year of transfer. 45.2, the year of transfer is what? We have to completely ignore that. We should ignore what? When it is converted. When is it converted? 18-19. But when should I compute the capital gain? General rule, I should compute in the year of transfer. Taking the same rule, I should have computed in 18-19. But no. This exception says you should calculate in the year when that particular stock was sold. When was it sold in my example? 22-23. So I should calculate. So as I told you, year of transfer should be ignored. That is, conversion of capital asset into stock in trade should be ignored. When will the tax arise? When the jewelry is sold. 22-23. So again I repeat, general rule, whenever I sell the capital asset, in the year of transfer only I should compute capital gain tax. But there are 4 exceptions. In that we are only doing the second exception. Conversion of capital asset into stock in trade. Since conversion of capital asset into stock in trade is a transfer, ideally transfer should have happened in 18-19. Capital gain calculation should have happened in 18-19. But the lawmaker says no, because you just converted, but did you actually sell it? No. When are you selling it? Some 22-23. So that year will be the year of transfer. Very simple. If some part stuff can be sold, all that thing, it's the same. You have to see and then decide. Right. So one is conversion of stock in trade into capital asset, conversion, compulsory acquisition of capital asset, destruction of capital asset. So this we did already. Now let's do this. Damage or destruction of capital asset. So guys, I had an asset. Let's say I purchased it in 15-16. It got destroyed by fire in 2021. It got destroyed by fire in 2021. Got destroyed by fire in 2021. What to do? But insurance compensation I received only in 22-23. Is destruction a transfer? Yes. Extinguishment of right. I don't have the asset only. Extinguishment of the asset. Definitely transfer. But when did I receive money? 22-23. So this also, whenever insurance money is received, only then it will be deemed to be transfer. Insurance received from insurance company on account of damage or destruction of any capital asset is chargeable under the head capital gain. Year of transfer, previous year in which the asset was destroyed or damaged. Year of chargeability, previous year in which insurance money or other asset is received from the insurance company. What will be the period of holding? Date of acquisition till the date of destruction. Mind you, period of holding, no change. It is from the date of acquisition to date of destruction. That is from 15-16 to 2021 only is the period of holding. Only what is postponed? Taxability. Taxability is postponed to 22-23. The period of holding remains the same. Same here also in the conversion of capital asset into stock in trade. What is the period of holding? Whenever the jewelry was bought till 18-19. What is postponed? Tax portion is postponed. Taxability is postponed. Third one, compulsory acquisition of a capital asset. Compulsory acquisition of a capital asset. So, for example, 2001-2002, cost was 3 lakh, right? And compulsory acquisition happened in 15-16. Compulsory acquisition, 2 clause 47. So, this is the period of holding. So, what happened, guys? 1 and 2, the cost was 3 lakh building. 15-16, who took over? Government took over. So, as we have seen, is compulsory acquisition a transfer? Yes. When is the transfer taking place? 15-16. Ideally, when should I pay the tax? 15-16. But then money only I have not received. What I will pay tax? I don't know how much you will pay also. Hence, what will be the period of holding though? Period of holding, same. 2001 to 15-16. No change in that also. What is postponed here? Tax portion. The year of transfer will be 15-16. Let us say compensation I have received in 22-23. So what is the year of tax? 22-23. Year of tax 22-23. Right? So I repeat, cost when you actually had bought it was 3 lakh rupees in 2001-2002. Period of holding, I held it till which year? 15-16. When did I compulsorily acquire? 2 clause 47, 15-16. So what is the year of transfer? 15-16. What is the year of tax? 22-23. 22-23 is the year of tax. Why? Because that is the year when the compensation was received. So compensation is received 30 lakh rupees, assume 30 lakh rupees compensation was received. It is called as initial compensation. That is a short thing that you will definitely receive. Then you are not happy with 30 lakhs. You will go for more. You say I want 20 lakhs more, 30 lakhs more. So that is called additional compensation. Let us say you receive that additional compensation in 25-26. Now standing in 22-23, did you know that you will get 20 lakhs exactly? No. So can I say additional compensation depends on the facts of the case? Sometimes I may get 20, sometimes I may not get anything, sometimes it may be just 10, 15, 16, etc. But initial compensation 30 lakhs fully it will come. Initial compensation 30, additional compensation depends on the facts of the case. So here it is additional compensation 20 lakh. Anyway, so now what is the period of holding, mind you? 0102 to 1516. That will not change at all. What is postponed here? Taxation. So taxation is postponed where? Till 22-23. Now my question is, additional compensation of 25-26, should I charge it in 22-23? What should I do? All that we need to see. So let's see. Compensation general rule. General rule, initial compensation, what should I do? FEOC. FEOC means full value of consideration minus cost of acquisition, index cost of acquisition, minus cost of improvement, index cost of improvement. Then what I get is short term or long term capital gain. Then additional compensation is what? Full value of consideration, additional compensation less litigation charges they will allow. Why? Because I want more. When I want more, I have to put a legal case. Legal case is for that extra 20 lakhs only, no? Yes. So that 20 lakhs I can subtract. This also is short term or long term. Same. And period of holding is the same. Date of acquisition to date of transfer. That will not change only. Here there is no cost of acquisition. For additional compensation, no cost of acquisition because that is already calculated in initial compensation. So I am not happy with that 30 lakhs. I want more 20. For that more 20, what will be the cost? Litigation. Court case. So that is the general rule we need to keep in mind. Now what they'll give you some variations we will discuss. Initial compensation in my example was 30. But do you think government will pay 30 that time only? No. So I'm working on some government projects to teach CA classes to all villages in Karnataka. There, I was talking to a person who was doing some other courses, etc. I'll ask them, what is the payment? I asked them. They said, sir, payment they'll tell. Mother promise, I'll give you. Then minimum 1 year delay. Minimum 1 year. Crazy. So that is minimum 1 year, that after going and begging, etc. Then a lot of bribes will be there. All those things. So yes, it's very normal. Right? So 30 lakhs initial compensation received in installment. In that 30 lakhs, 20 lakh will be received in 22-23. 5 lakh is received in 23-24. 5 lakh 24-25. They will only give 30 lakhs. No. Now you take 20 lakhs. Next year 5 lakhs. Next year 5 lakhs. I'll give you. Promise. But guys, Nirmala madam says, see, when the government has told 30 lakhs, I will definitely give you 30 lakhs. I asked the same question to that guy. Sir, why are you doing these government projects when so much money is blocked? He said, sir, there may be delay, but definitely they will pay. So it's like short. When they tell you 30 lakhs guarantee they'll pay. But time, 5 months, 6 months, 7 months, there is no chance of them not paying. That's for sure. With government deals, there is no chance of them not paying. So how much will it be taxed in 22-23 only? Full 30 lakhs is taxed. Why? Even though 20 is received. Why? Because government payments are short. So initial compensation declared by government 30 lakhs, irrespective of the payment. When will you tax it? Full 30 lakhs in the year of receipt of first installment. But what about additional compensation? Additional compensation is what you have claimed. Will they pay you whatever you have claimed? No. They'll pay you something little. You will not happy with that. You will again put one case. Then they'll pay you something later. So if you see, if additional compensation is received in installments, in the 20 lakh, 10 lakh, previous year 25, 26 I received. 6 lakh, 26, 27 I received. 4 lakh, 27, 28 will receive. This will be taxed as and when I have received it. Because payment is not at all sure and it depends on the facts of the case. If interest is received on delayed payment of compensation, yes, if there is a delay of 6 months, 7 months, 8 months, 9 months, 10 months, they will definitely give you delayed payment. Interest they have to pay. that is taxable as IFOS in the year of receipt. Is full amount taxed? No. 50% is taxed. Based on the interest received, mind you, not interest accrued. Some things you can charge accrued interest, but here it should be the amount of interest received, because this is an extra portion which the government may or may not pay. Always taxable on interest received basis. How much? Into 50%. 50% is standard deduction. Because to get that you would have spent a lot of time. So that is the thing, guys. Full compensation, short compensation, whenever you say I don't care, first installment fully taxed. Next, the additional compensation received in installments should be taxed when? As and when you receive. Third one, interest portion on enhanced compensation or whatever compensation is on receipt basis. Very, very simple. These are the two variations. Third variation, they will tell court has given an interim order. What is this interim order? They'll say, okay, you have asked for 20 lakhs extra. Let me make an order now that 5 lakhs has to be paid immediately. 15 lakhs later, the final order. I have to see more facts and circumstances, etc. By reading the prima facie, reading the facts, it appears that 5 lakhs to pakka you will get. So take 5 lakhs now only. But pending final order. Final order, I will see whether 5 can be 7, 7 can become 10, 10 can become 15, or it can remain 5 only. That we'll see later. So, in that 20 lakh, 5 lakh is interim order. Interim means until we are waiting for the final, 5 lakh short you will get. 15 lakh final order pending. So if you see interim order passed in 1920, compensation also granted 5 lakh received in 1920. Final order is passed for 12 lakhs in 22-23. Now the question is, 5 lakhs received in 1920, what to do? 6 lakh you received where? In 22-23. 1 lakh you received in 23-24. Now that 6 lakh and that 1 extra 1 lakh, totally how much I had claimed, guys? 20 lakhs. What was the short interim order? 5 lakhs. Then finally how much they settled for? 12 lakhs. So 12 lakhs minus 5 lakhs is 7 lakhs. In that 7 lakhs, 6 lakhs are received in 22-23, 1 lakh are received in 23-24. Right? So here, this is as per variation 2 only, as and when you receive, only for second one and third one. Second one, 6 lakhs received in 22-23, compensation due to final order, it is taxable in the year of receipt, 22-23. 1 lakh is received in 23-24, compensation due to final order, year of receipt, taxable in the year 23-24. This is variation number 2. That's fine. But only one change is this. 5 lakh rupees was received in 1920 due to interim order. What is the variation 2? It says you should tax it in the year of receipt. But variation 3 overrides variation 2. Only for this interim order, it is taxed in the year when final order is passed. Taxed in the year in which final order is passed. When is the final order passed? 22-23. Is an exception. Is an exception. They will say, okay, I have passed interim order, you take the money now, that's okay, but wait for the final order. That day only you tax everything. So this 5 lakhs I have promised now, but 2 years later the final order is passed. When will the capital gain come? 2 years later. Right? Whereas the other compensation, as and when I received, I have to keep that on track. As and when I received, I have to keep that on track. Are we clear, guys? All of you? Any doubts? Yes. However, there is one law, like one rap song. Right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act. CA rap song this is. So this law, if any compensation is paid under this law, Right to Fair Compensation and Transparency in Land Acquisition, Rehabilitation and Resettlement Act. This is what defense, that is army, navy, coming and taking over your property. They'll say, you get out, I want to have a army base here. So if you've gone to Gangama circle, from your Elanga Gangama circle, that entire thing area was normal area. They acquired, army acquired, and there's an army camp there. So when they pay compensation, since it is used for what? Defense purposes, that amount will not be taxable, fully exempt. It is exempt. So yes, destruction again we will quickly revise. That's all about compulsory acquisition. So we did what? Four exemptions are there. First exemption, conversion of capital asset into stock in trade. Second one, damage or destruction. Third one, compulsory acquisition. In damage or destruction, extra points is it should happen only due to these things: natural calamity, enemy attack, fire, rioting, etc. You only destroy and then you go claim? No. It should happen because of various reasons. Force majeure or act of God. So insurance compensation, whenever you receive it, it is taxed in that year only. It is taxed in that year. Either the insurance claim you have received. What if you have received an asset only? I had a bus which was used for business purposes, right? Or I had, gold got completely destroyed, theft happened, whatever, enemy attack happened, they took away. Now government says I cannot pay you, sorry, insurance company says I cannot pay you that, but I will give you same gold. Whatever it is, in the same form I will give you. Then they say FMV of the asset received. FMV of the asset received. So 3 items are done. One more item is there in this JDA, Joint Development Agreement. So in joint development agreement, what happens? The possession is handed over to the builder. In joint agreement, I have a land, you are the builder. You will come to me and say, will you give this land to me? I'll say, okay, what will I get in return? They'll say, this land is worth around 20 crores actually. So what I'll do is, I will give you some 10 crores. Instead of the remaining 10 crores, I will give you 2 houses. And those 2 houses, when I actually build it, each house only will be worth some 10-15 crores. So actually you are getting some 40-50 crore, be happy. I will not buy the land and I will not construct. Let's do a JDA, Joint Development Agreement. In the joint development, your responsibility is giving the land, my responsibility is building the entire property, and I will give you 2 homes in that. So now, the thing is, whenever I immediately pay you that 10 crores, whatever I told you, that is immediately taxed. But what is not given to you then and there? Building can take 2 years, 3 years, 4 years. So though the actual value you are receiving for a 20 crore property is 45-50 crore, I will not tax you 45-50 crore then and there. When will I tax? When I construct when the builder constructs the building and transfers when is the year of transfer? Possession is handed over to the builder. What is handed over? The entire land is handed over to the builder. That only is the year of transfer. So I had bought that property in 2012-2013. I transferred the entire land to the builder in 22-23. Yes, that's the year of transfer. But that building, that fellow took 3 years to construct. 26-27, he gave me back the building. I mean, in that 2 houses he gave me. What is that? When is it taxed? It is taxed in that year of tax in which completion certificate is received. Either it can be part or either it can be full. Completion certificate is the key here. Completion certificate is the key. These are all the things: 45(1)(a), 45(2), 45(5), 45(5). Completion certificate is the key. Destruction of capital asset, destruction, insurance claim received, conversion of capital into stock in trade, conversion into stock in trade where stock is sold, all these things. The possession is handed over to the builder, completion certificate, part or whole, all these areas. So these are all the general provisions. These are all the general provisions. Now some special provisions. First one, section 50C, special provision number 1, section 50C. When SDV is treated as FVOC. So Ambi is transferring land of 70 lakh. 70 lakh he will give it in bank, but the real value of the land is 110 lakh. 110 lakh is something called as a stamp duty value. But what I will do, instead of taking the real value, I will say no problem sir, I want to sell it at less only, 70 lakh. And 70 lakh I got in bank. Income tax department says it is up to you. You sell it at 20 lakh, 30 lakh, 40 lakh, but the moment you sell less than the stamp duty value, which is the bare minimum value as fixed by the stamp authority, I will assume it to be what? Undervalued. I will say it is inadequate consideration. It's up to you. 70 lakh, you sell it for 70 lakh. I don't have a problem. I will not come and say, why are you selling at 70 lakh? But to me, for tax purposes, I will take what value? 110. You may sell at 20, 30, 40, 10. You may give it free also. I don't care. But I will take for taxation purposes 110. What is the full value of consideration? 70 lakh. What is the actual SDV? 110 lakh. Because I know you are not a fool to sell anything for less. You have shown 70 lakh, 40 lakh, you have taken cash. Now I cannot sit and catch you. I will assume that you sold for cash. Please pay tax on 110. I don't care. It is what it is. So if SDV in my example 110 is greater than consideration 70, then what should I take? FPOC will be SDV. So this will apply to what, guys? Land and building or both. If land and building is held as a capital asset and sold for less, then 50C will come. That is what we are seeing. If land and building is held as stock in trade, then 43CA will come. There also same thing. We had seen this in PGVP. 43CA means what? Same. If you are holding it as stock in trade, the actual value is 110. You want less tax. What will you do? Sell it only for 70. Show your PGVP income as 70. 40 lakhs you will take cash. You will not disclose also. Happy. No. In both the cases they are told what? If the FVOC happens to be less than the SDV, then SDV will be FVOC. But then they went to the ministry and said, sir, exactly FVOC will be greater than SDV. That's okay, sir. But then give some threshold, some percentage you give. They said, okay. What was the threshold? 110%. So what is the scene now? SDV, if it is here, SDV, if it is less than or equal to 110% of consideration, then consideration is equal to FPOC. But if SDV is greater than 110% of consideration, your consideration is 70 lakh. What is 110%? Up to 77 lakh, no problem. That much discount you give. SDV 77 lakh, how much have you given? 70 lakh. Okay, no problem. But SDV 70 lakh, SDV is 110 lakh, you are selling it for 70, where 40 lakh difference. No. So if your consideration is 70, but SDV happens to be 77, 76, okay, no problem, fine. Because 110% of consideration is 77. But if you cheat like that, then I will not agree. Right? So this is the thing. So now, in some cases 120%, we'll see later, only in one case, but in all cases it is 110. So rather than just making SDV greater than consideration, they added that threshold of 110%. to make things easy. Very, very simple. So if they ask you a question like, consideration is 50, SDV is 57 lakh. What is 110% of consideration? 55 lakh. It's 55 lakh or 57 lakh. What will you take? FPOC will be SDV 57 lakh, right? Yes. But guys, sometimes what happens is, take this example only. Consideration is 50 lakh. What is 110% of consideration? 55 lakh. What is SDV? 57 lakh. What should I take ideally? 57 lakh. But I go to the valuation, I go to the government and say, sir, I agree. 110, I totally agree. Sir, but this is a genuine case. This was a place where people are telling this house is haunted. Rumors have already spread in the market. I totally understand in and around houses are selling at 57 lakh. I totally agree. But according to me, the fair market value is less. Fair market value is the price the person is ready to pay. SDV is whatever you think people will pay. Okay, what you think people will pay 57 lakhs, you're 100% right. But this particular house, FMV is less because people are telling it's haunted. Or people, the next door only there's a crematorium. So balcony view is what? Seeing dead bodies. So people, your entire area FMV are 100% right, 57. You are totally agree. But sir, this house, 50 lakh getting only is a big thing. So I don't agree for you telling that it is 57 lakh. Like one of my auntie's property is getting sold, still getting sold, going on and on. Super property, her fair market value is 5 CR, 7 CR actually. But she's only getting 4 CR. Why? Because it's in an area where landslides will happen. In Madikeri, Kurg district. That area only, that house, land, not hill is there only. Tomorrow you and hill will be the same. With your house only will become hill. Anytime it can happen. It has happened also destroying one wall portion before. So people are like, no. I understand entire area 7 crore for this house, I know. But this house I will not pay. Directly in front of the hill it is. And there is one solitary house. No. So yes. In that case, what should I go? I should go to the valuation officer and beg him. I should tell him, sir, this is what it is, sir. Please help me out. Please help me out. So if the value determined by the valuation officer happens to be less than SDV, means what? What is my SDV in my example? 57 lakhs. Sorry, here, what is SDV? This example only will take. What is SDV? Yeah, 57 lakhs. Correct. So he will now say, okay, let me make it. The valuation officer will say, it is actually, in my opinion, it should be 54 lakh, not 57 lakh. Then okay, valuation officers only will be FPOC. Second, if value determined by valuation officer is less than the selling price, how much did I sell it for? 50. Valuation officer says 35. I'm scared of ghost. 35. So government says, no, 35 and all, I cannot give the capital gain. There will be nothing left for me. So they said, ignore. Selling price only will be FPOC. Basically, valuation officer's value cannot be less than selling price. If the valuation determined by valuation officer happens to be more than the SDV only. SDV is how much? 57 lakh. Valuation officer, your booth and all will not come. It is 60 lakhs actually. Then also we will ignore. The only area when valuation officer can help you if the value happens to be less than SDV. Like for example, your consideration is 40 lakh that you have got, but SDV is 70 lakh. Income tax officer is asking you on 70 lakh. Then I will go and beg valuation officer, sir, this is not 70, sir, please. And valuation officer will make it 50. then the tax is computed on 50, not on 70. That's what they say. But the valuation officer comes to 35 lakh, then government says, boss, you already got 40, no, please pay on 40 rupees. These are all the important areas. This is the next special area that we have discussed. Second one is what? Advance money forfeited. Advance money forfeited means what? Token money. Advance money means what? Token money. Means what, guys? I have received an advance, like for example, Mr. RCB has acquired in the year 22-23, 70 lakh one house he has acquired. He is supposed to sell it to Mr. CSK, correct, in 2007-2009. Sold it also for 1 crore. The discussion was done for 1 crore. He received an advance of 15 lakh. And let's say CSK will not buy that. What happens? RCB can forfeit that entire amount of 15 lakh. Now the question was, that 15 lakh I am receiving, is that a capital receipt not taxable? Or should I take that 15 lakh as IFOS income? Is it income or is it just a capital receipt? Not at all taxable. Advance, that fellow didn't take it back and advance is forfeited. Agreement clearly said that if you do not buy within this time, whatever advance you pay, I will ignore. I will forfeit. Forfeit means I will take it, eat it up. The RCB has received 15 lakh advance, it is forfeited. The question is, will it be, there is no refund seen. First of all, will it be taxed or will it not be taxed? If it is taxed, under which head? IFOS or PGBP or capital gain? It can't be PGBP. Is it IFOS or in capital gain? Will you tax, not tax? Let's say some 2022-23, you sold it for 10 crore. There you will add. Adding in the income is the same as reducing from the cost. Will you reduce from this 70 lakh? Your cost was 70 lakh. Will you reduce? All those things were there. So final decision was, there used to be a section called section 51. So if advance money is forfeited, you have to remember these dates. Before 1st April 2014, then section 51 comes. According to section 51, very illogical section, you should reduce from the cost of acquisition. I acquired the house in 70 lakh. Advance I received, I acquired my house for 70 lakh in 2002-2003. When did I receive the advance? 2009-2010. When I am selling the house for 20 crore, what should I take the cost as? 70 lakh minus 15 lakh. Completely illogical. So if the asset was acquired on or after 1/4/2001, I should reduce from the cost. Or I should reduce from the FMV as on 1/4/2001. Or I should reduce from the WDV in case of depreciable asset. Illogical. But after 1/4/2014, this makes sense. Keep that 70 lakhs intact. But this 15 lakh you have received, no. Is it a capital receipt not taxable? No, I will tax it. Under IFOS. Advance money forfeited under 56(2)(9) will be taxable under IFOS. 15 lakhs you have to pay tax on 15 lakhs. Where? When? In the year of forfeiture. In the year of forfeiture, you need to pay the tax to me. Online people, are you getting it? Yes, in the year of forfeiture. Now it makes sense. So in the exam, you just need to remember the dates. 1/4/2014 and after 1/4/2014. After 1/4/2014, if it's forfeited, 56(2)(9) IFOS. Now in the same example, if RCB gave it to, here I'll show you one example. So in this case, here, if the advance money is forfeited by previous owner, see, in 2002-2003, had a property of 1 crore, was about to sell to Sriram, but 10 lakhs is forfeited by this lady. Now she gifts it to one more guy in the year 1450, right? And then this guy sells it for 4 crore. The question is gift a transfer? No. We had seen the transfer definition. Gift is not at all a transfer. And what is the period of holding for any gift situation? Period of holding of the previous owner plus current owner. Current owner held it from 2014-15 to 22-23. Previous owner held it from 2002-2003 to 14-15. So what is the period of holding for this full? Cost of improvement will be cost of previous owner and incurred by current owner. That also is there. But the question is, what happens to this advance money forfeited? It has happened in 9-10. Wasn't it before 1/4/2014? Yes. Ideally speaking, I should subtract from the cost. But the wordings of the law are such that it is only for the current owner. So advance money forfeited by previous owner has to be ignored. This also is illogical, but that's the law. So advance money, that 10 lakh which was forfeited by this lady, has to be ignored while computing the calculation of this guy. Why? Because that was received by somebody else. It was received by whom? The lady. And was forfeited by the lady. And this guy had nothing to do with that. But predominantly again it's illogical because that remained untaxed now. Anything received before 1/4/2014 was not taxed. Anyway, an illogical point, nothing can be done. The special provision number 3, what is not considered a transfer? Quickly we'll see. These items are not considered to be transfers, exempt. HUF giving the asset to family member is not a transfer. Any gift, any will or inheritance is not a transfer. Father gifting their property to children, not a transfer. Similarly, holding company transferring assets to 100% subsidiary, not a transfer. 100% subsidiary giving to holding company, not a transfer. These are some of the exempt transfers. So we'll see that here. All this valuation officer we saw. Advance money forfeited we saw. So in this example, previous owner Mr. Raj, his husband, on 5/4/2018, he will gift this entire property to the wife. Not a transfer, no capital gain. The wife, present owner, sells it to this Mr. Kunal. What is the period of holding? It should take from the previous owner also. 2001-2002 to 21-22. FPOC 80 lakh minus transfer expenses, net consideration minus cost of acquisition. Cost to the previous owner will be cost of the previous owner, 5 lakh. Cost to Mrs. Simran will be cost to Mr. Raj, 5 lakh. Into period of holding will be what? This year, the year of sale, divided by 2001-2002, 100. So parent company, subsidiary company, all that not covered. In any amalgamation, amalgamating, all the property of the amalgamating company should become the property of the amalgamated company. All the liabilities of the amalgamating company should become properties of the amalgamated company, and shareholders holding not less than 75% should become the shareholders of the amalgamated company. Similar concept with demerger also. All these things. So demerged company, all this same thing. So IBM, if it demerges into hardware and software, and the hardware resulting company becomes IBM India, it is not a capital asset, not a transfer. However, the software company becomes Sigma Incorporated UK, resulting company. This Income Tax Act only will not come because it's a company abroad. Shares, bonds, deposit, etc. will be converted to shares or debentures of that company only. You had debentures of one company, they converted it into shares of that company only. So, not a transfer. Redemption of sovereign gold bond issued by RBI under sovereign gold scheme. There's one more sovereign gold scheme. They'll buy your gold and they'll give you money. Though it is actually capital asset, we saw if that this is not a gold monetization scheme, it's a different scheme, sovereign gold bonds. There, whatever money RBI gives you is not a transfer. So if you see here, only what all was covered, bonds, debentures, debenture stock into shares or debentures were covered. But conversion of preference shares were not given. Hence, they added that also. Conversion of preference shares of a company into equity shares of that company is not regarded as transfer. That company it is. Mind you, because what used to happen was, in the exam if they give you Tata Steel, the preference shares of Tata Steel were converted to equity shares of Tata Motors. Tata you can't write, correct? So it is that company only exempt. If they convert to any other company of the same group, not exempt. Then reverse mortgage scheme. What happens in reverse mortgage? Where the property, the house will be taken, if you are like 65, 70-year-old, your children have run away, now what you need some money. What will you do? You will go to the government and the reverse mortgage scheme and you will hand over your house to them. They will give you a lump sum amount. Let's say the property value is 10 crore, they will give you 5 crore lump sum. And remaining 5 crore, they will pay you in equal installments every month until you die. Now that you have transferred the asset to them and you are getting money from the government, isn't it actually transfer? Yes. But government says reverse mortgage is not transfer. But after this reverse mortgage happens, 10 years later you are still alive. Now you want to reacquire the property from the government. Then is it a transfer? Yes. Final, when you are reacquiring the property, that is a transfer. Initially, when you are selling the house to the government and in the bank and bank is giving you that money, it is not transfer. Very, very simple. Similarly, transfer of rupee denominated bonds or government securities by one non-resident to another non-resident outside India is also not a transfer, because I am helping them invest in INR. Correct? Because they will, when they invest in INR, they have to give dollars and dollars will get converted. So I will have a lot of forex reserves. So country, it's better for my country to have forex reserves. Every point has logic, no mugging up. So transfer of RDB or government securities by one non-resident to another non-resident outside India. Good only, because he is now transferring to that guy and that guy is, pumping in a lot of foreign exchange to the country. So that is the scene. Cool. So we'll take a break and then we will continue with bonus shares, right shares and all those things. It's an important concept. We'll have to finish it. Okay. And after that, exemptions are also there. 54. Exemptions also very important. So online people, I'm not going to end the stream and all, but we will just take a break. Okay. 130 almost, 145, 145. Yes. Okay. So next is bonus shares. Let's see bonus shares. Now this is special provision 4. 3 special provisions we have done. One is what is not a transfer when we did that SDV concept, all that. Point number 3, bonus shares. Now, bonus shares can be two things. One, bonus share can be acquired before 1/4/2001. Second one, it can be acquired on or after 1/4/2001. All bonus shares acquired after 1/4/2001, then the cost of acquisition will be nil, because bonus is not, it's just capitalization of reserves. So if they have reserves and surplus of 100, they will convert it into equity shares. There is actually no transfer. But in the old law, before 1/4/2001, illogical point used to be there. The date of allotment to the date of transfer used to be the period of holding. And what would be the cost of acquisition? They took it as cost as nil or FMV, whichever is higher. So even for the bonus shares, they were taking as FMV. But technically, for bonus shares, there is no cost involved. Actually, there is no cost involved at all. So if you are getting bonus shares, instead of 1, you are getting 2. There is no cost involved there. But unfortunately, old law, that got deleted, but still now we have to use the same logic. We have to use the same logic. As far as right issue is concerned, I can do two things. As I told you, in 2020, market price of Reliance was 1,600, but the right issue was 1,300. 300 rupees at a lesser rate they had to sell. They were selling. This, let's say I have a right to purchase 50 right shares. That is my entitlement, 50 shares. Now, I acquired 50 shares. 50 shares into 1,300, that is the issue price. So this very simple, if I have taken the issue price, this will period of holding of that right shares will be from the date of allotment. So 2 years later, 3 years later, if I sell it off, then it's the same thing. So that is same as buying new shares. But what will be my capital gain calculation if I renounce my right, surrender my right, relinquished my right, if that be the case? So PJ surrendered to Sheila Aunty. So if I sold the right to how much? 200 rupees per share, what will happen? So 50 shares into 200 rupees per share it will be. Why? Because I sold the right for 200. So 1,300, basically market price was 1,600. If Sheila wanted to buy from Reliance directly, 1,600. But if she is buying from me, how much will it be? 1,300 she is to give to the company, because company has offered me at 1,300. Plus she has to pay me 200. Still it's less, 100 rupees less than market. So she would definitely purchase from me anyway. So if you see, sold right for 200 rupees per share for me, because I sold the right. This is a transfer. FPOC is 50 share into 200. Cost of acquisition is nil. I didn't have to do anything for that. And this is always short term, because the right shares window is open only for maximum 1 month. Actually, it's 15 days. That's it. So it can never be long term. But for Sheila Aunty, two things will happen. One, her cost of acquisition will be what? 1,300 rupees she has to pay Reliance, 200 rupees she has to pay me. So 1,500 into 50 will be the cost of acquisition for Sheila Aunty. That's it. That's very, very simple. So this is regarding bonus shares and right shares. Then some other points. In case of debentures and bonds, there is no concept of indexation. There is no concept of indexation for debentures and bonds. Why? Because in debentures and bonds, it doesn't fluctuate as much as shares. Hence, there is no indexation. But there are two exceptions. These two exceptions, indexation will come. One is capital index. Now, capital index bond is something which is completely discontinued. So only theoretically they can give you. But sovereign gold bonds issued by RBI, you will get indexation benefit if you sell those sovereign gold bonds. So if they ask you sovereign gold bonds related stuff, sovereign gold bonds issued by RBI, the maturity period is always 8 years. If it is issued by individual, you will redeem it on maturity. When you are redeeming it on maturity, then it is not a transfer. Hence, no capital gain will come due to section 47, because you are redeeming at maturity. On the other hand, If you are redeeming before maturity or selling off the bonds before 8 years, then capital gain will apply. And also you will get what? Indexation benefit. You will get indexation benefit. On the other hand, if you are any other SSE, as a not an individual, you are a company, whether you redeem on or before maturity, there is no specific exemption. It is considered as a transfer. Capital gain will apply, and indexation benefit can be taken. That is what it is. This is special provision number 4. Special provision number 5 is the concept of slump sale. We had seen it in PGBP in the WDV concept actual cost. One more thing was there, minus WDV in slump sale. In slump sale, what happens is I will sell my undertaking itself. I'll sell my segment, I sell my division for a lump sum payment. So ITC, it will have tobacco, FMCG, hotel, stationery, everything will be done in a block, etc. One part, stationery, they will sell it off. So what is the FVOC? FMV as per rule number 11 UAE that they'll give in the exam. So FVOC will be the FMV of that particular unit. You have to calculate less transfer. Whatever you get is net consideration. Less cost of acquisition. And that cost of acquisition will be my net worth of that particular company. Net worth of which one? Of the stationery division. So period of holding will be more from when the undertaking was started till when the undertaking was transferred in slump sale. And very simple, again I repeat, FPOC will be FMV as per rule 11 AE minus transfer expenses, you will get net consideration, and less again what? Cost of acquisition, that is your net worth. And what is your net worth? Asset. If it's a depreciable asset, WDV as per Income Tax Act. For a non-depreciable asset, then book value. And whatever you get, less liability. You will do liability also will be at book value, and what you get finally is your net worth. Depreciable asset will be WDV as per Income Tax Act, non-depreciable asset book value, and then less liability, net worth is what? Whatever you get in the end. That's about it. So here FEOC minus transfer, net consideration minus net worth you have to do. So that's simple again. All the questions and all we cannot do now. There's no time. Yes, special provision number 6. This is capital gain in case of intangible assets. I sold, especially goodwill. I sold goodwill of 2 crore. Cost of acquisition. What is the cost of acquisition of goodwill? It cannot be determined. So, in one Supreme Court judgment called BC Srinivasa Shetty, they said since cost cannot be determined, capital gain will not arise. So, if you sell goodwill, MTR has sold their name. At that time, what if they said that goodwill only it is? They sold it to some Swedish company. So, all your the savories of MTR does not belong to MTR. It belongs to a Swedish company. So, Swedish company has bought the rights for what? MTR savories. Now, MTR savories now, when they are calculating their capital gain, selling amount to some 10 crore, 100 crore, cost nil, not nil, indeterminate. How will you measure what is the cost of MTRs? How did they start it? When did they start? How much the efforts they put? So BC Srinivasa Shetty said indeterminate, which means that entire 100 crore was not taxable. Capital receipt not taxable. Do you think government will like this? No. They changed the law. What did they say? In case of goodwill, trademark, right to manufacture, tenancy rights, LUMARs, route permits, etc., cost of acquisition will be nil, deadly. If you make it nil, full 100 crore is taxed. But if you make it indeterminate, nothing is taxed. So they said for self-generated asset like MTR, self-generated brand name, it is nil. If you are purchasing, however, then the purchase price obviously. So I am purchasing from you. Like for example, for the Swedish company, tomorrow they want to sell that MTR name for 200 crore. What will be their sale value? 200. What is the cost? I paid 100 crore, no? 100 crore. But for MTR, what is the cost? Actually, now it is nil. So cost of acquisition, purchase price, yes, and FMV as on 1/4/2001, that benefit is not available, but yes, indexation benefit is given. Cost of improvement also for goodwill, patent, copyright, everything it is nil. For other assets, it is capital expenditure as on 1/4/2001 or after that. These are all the special points. Moving on to few more special points. Special point number 7. 50 CA. Capital gain in case of unquoted shares. Unquoted means what? Shares which are not listed. And then listed but not traded regularly. So you follow this structure only, it becomes very easy. That stupid institute has given some random stuff in between, it gets very confusing. So you follow this same structure, it's fine. That's why you revise. You study everything and revise through these videos, it will help you. So capital gain in case of unquoted shares. Unquoted means what? Shares are not listed or listed but not traded regularly. Means they are called penny stocks. If share value is less than FMV of such shares, so the government has told FPOC will be the FMV. Less than that, I am not going to allow. Because share value should be at least, whatever value you are showing should be at least the FMV according to my calculation. This is also based on valuation. So it should be based on that only. Special provision number 8, consideration where it is indeterminate. Consideration which is indeterminate. So if I have some are determinate, some are indeterminate. If I give you a house worth 10 lakh, or rather costing me 10 lakh, but now it's worth 1 crore. But from you I have received a gold bar. What is the sale value? It's an exchange of asset. Exchange of asset is a transfer, we have seen. But what is the value I should take now? My house is worth 1 crore. The gold bar may be worth 85 lakhs. The gold bar may be worth 1.5 crore. I don't know. So lawmaker says cross concept. So this fellow's FPOC will be whatever was exchanged, 1 crore. And if, for example, the FME of the gold bar was 1.5 crore, that will be the FPOC of the guy who is exchanging. So if I have given you a house worth 1 crore for 1.5 crore, what is my FPOC? 1.5 crore. And for you, what is your cost of acquisition? 1 crore. That is reverse. Second, if I have given you an asset gold bar and I'll say I'll come for your house for breakfast every day. What? Everyday breakfast. So what is this? Not determinate. So they say whatever FMB of the asset that you have given, that itself will be the FPOC. So basically here they say FPOC will be the FMB of the asset transferred. So I will give you gold bar worth 1 crore and I'll tell you, you need to refer all your clients to me. Whoever new clients you get for direct taxation, you should refer to me. That's the deal. Now you may refer 10, 20, 30, 40, 50 and because of that I may make business worth 40 crore. But as per law, what should be the full value of consideration? FMV of the asset transferred. What is FMV of asset transferred? 1 crore. That is special provision number 8. Special provision number 9. This is what the first proviso to section 48. This says, in case of shares and debentures transferred by non-resident. Non-resident. What do they say? You should do something called as TTBR and TTSR. For example, US resident had $1 lakh. $1 was 70 rupees. How much is the amount totally? 70 lakh rupees. 10,000 shares he bought at 700 rupees he bought because now he wanted to invest how much? 70 lakh rupees in India. He sold these shares at 800 rupees. How much he got? 80 lakh. What is the capital gain? 10 lakh. At the time of sale, what was $1? 85 rupees. So actually, what is the income that he earned? 80 lakh divided by 85 is 94,118. How much did he invest? $1 lakh. How much did he get back? 94,118. But actually, what is the profit in INR? 10 lakh. But why is that INR not coming into the picture? Because dollar rate has changed. Instead of 10 lakh profit, I am making $6,000, almost $5,700, $800 loss. So my outflow is 1 lakh, inflow is this thing, 5882 loss. Plus you are making me tax also, putting tax on 10 lakhs. How is it fair? All foreigners started running away. Then they said, okay, no problem. I'll give you a special calculation. First proviso to section 48. So that what you will take is, take everything in dollars only. Average rate of tax, dollars on date of transfer. Less transfer expenses. That is average rate on date of transfer. Net consideration. Cost of acquisition, no indexation benefit. Then it will be short term or long term in foreign currency. Convert into INR, TTBR on the date of transfer. So everything you convert to foreign currency. FEOC you make it average rate, TTBR plus TTSR, telegraphic transfer buying rate, telegraphic transfer selling rate divided by 2. Less transfer expenses, make it average rate on date of transfer. Net consideration. Cost of acquisition, no indexation benefit. You will get short term or long term in foreign currency. Convert into INR, TTBR on date of transfer. Average rate, TTBR, TTSR divided by 2. Dollar or any other rate. Any other currency. Next is, before we go to tax under the capital gains, this is your LTCG, STCG. Let us now finish off the exemptions. Exemptions that were there. One by one. First exemption is exemption on selling house property. Section 54. As per section 54, who is the eligible assessee, individual or HF? What is the asset being transferred? Residential house property. What is the nature of capital gain on asset transfer? It can be long term or no, not short term, only long term capital gain. Fourth one, what is the asset to be acquired to avail exemption? One, residential house property in India. In India. So if you read the structure here, very simple. Mr. Raj sells, individual HF sells residential house property. Then from whatever he sells, he will buy a new house property, residential house property. When should he buy or construct this? He should start construction 1 year before the date of transfer of the other house. Old house he will sell 1 year before only. He should have started construction of the new house. Or after selling the old house, he should buy the new house within 2 years after the selling of the old house, or he should construct within 3 years. Purchase within 2, construct within 3. Purchase within 2, construct within 3 years. He will give it what? Residential house property. He will invest there. Or let us say he doesn't have that much, doesn't want to invest. He wants to see what is going to happen in the future. He can invest it in something called capital gain account scheme. Capital gain account scheme. When should he deposit there into that account? Before return filing date. Before return filing date. And that amount should be utilized for what? It should be utilized for buying the house property. If it is not utilized, then whatever you have given exemption, everything will be withdrawn. Everything will be withdrawn. And what is the exemption that you're going to get? Capital gains or cost of the new asset or deposit amount, whichever is less. Capital gain, cost of the new asset or deposit amount, whichever is less. That is what you're going to get. So if it is a lock-in period, property cannot be transferred for 3 years. If transferred, capital gain exemption will be withdrawn, right? Yes. So just a sec, guys. You keep checking this. 2 minutes, I'll come. I told you not tomorrow. Regarding tomorrow, I'll just confirm. 2 minutes. Just keep reading something. 2 minutes. All right. All right, guys. So we will do the other class tomorrow. Let us keep what time? You want to come early? Or you guys are not coming anywhere, right? If you want to come, you can come, but there's no metro is there, but other things are not there. But I'll be taking from here only, no tension. So guys, tomorrow we'll do the other session. I will change the link and send it. Same link will be the same only, but date will change there. We'll do the 4th session tomorrow and finish it off so that you guys can study. So I was supposed to handle that thing, but because of the band that has been pushed off to October now. Cool. So we can finish our thing tomorrow. Tomorrow. 11 we can meet. 11. So tomorrow 11 a.m. Little early, 1 hour early. 11 a.m. guys tomorrow. I'll change the timing and send you the link for the online people. And you guys, if you want to come, you can come at 11. Anyway, I'll be sitting here and doing this. You can come. For us, no burn, nothing. Every day is the same day. Burn, no burn, everything is the same. Okay, yes. So let's continue. So purchase 1 year before or 2 years after, and then other one is 3 years after. Residential house property. Capital gain account scheme, and then what will happen? Property cannot be transferred for 3 years, and if transferred, capital gain exemption will be withdrawn, and then before due date of filing the return to be utilized for that buying that house property. If not utilized, then it is withdrawn. Capital gains, cost of asset, deposit amount, whichever is less is what you need to take it into account. Next, 54B, 54 capital B. What does this say? So, Mr. Raj, individual HF sells urban agricultural land. Urban agricultural land. So 54 is what, guys? House. Mind you, 54 is house. 54B is what? Selling agricultural, urban agricultural land used for agricultural purposes. 54 is for whom? Individual. 54B is also for whom? Individual or HF. Urban agriculture. This 54 is also individual or HF. What is he selling? Urban agricultural land used for agricultural purposes. It must have been used in the 2 years immediately preceding the date of transfer for agricultural purposes by individual or HF. There 54 it was LTCA. Here it is short term or long term, both. Asset to be acquired to avail exemption is what? Urban or rural agricultural land. Purchase new asset within 2 years after the date of transfer. Cost of new agricultural land or capital gain, whichever is lower. So if you see Mr. Raj, individual or HF, sells urban agricultural land. Proceeds of capital gain should be invested in urban or rural agricultural land. You can buy urban or rural, but what should he sell? Urban agricultural land. Mind you, they use the word urban agricultural land. They don't say owned by him. What do they say? Used by him for, by him, himself or parents 2 years before. I mean, for at least 2 years, sorry. And then this guy can buy a new land when? Within 2 years. Within 2 years. How long should the asset be used? How many years? 2 years. It should be used for 2 years. And how long can you, what do you say? When can you purchase the new asset? When should you purchase the new asset? Within 2 years. Within 2 years from the date of transfer. Yes. Then what happens? The time limit, all that is the same. 2 years and 2 years after. Capital gains or cost of new asset or deposit amount, whichever is less only, will be exempt. Exemption will be withdrawn if you don't invest in urban or rural agricultural land, or you don't put it in which account? Capital gain account scheme. And that property also, just like this one, there will be a lock-in period of 3 years. This new urban or rural agricultural land also, there would be a lock-in period of how long? How many years? How many years lock-in period? 3 years. If transferred, whatever capital gain exemption you had earlier will be withdrawn. Exemption for compulsory acquisition of industrial land and building, section 54D. Who's eligible SSE? All SSEs. And what is the asset transferred here? Here it is land or building or any right in the land or building forming part of an industrial undertaking. There must be, first of all, compulsory acquisition of the asset. It must have been used for 2 years, similar to 54B only, but here it is industrial undertaking, land and building, used for industrial purposes 2 years before. And proceeds of capital gain is invested in acquiring a new industrial land and building. And this is what, guys, 54B was voluntary transfer. 54D is compulsory acquisition. Nothing can be done. Or it is deposited in what? Capital gains account scheme. Same. Lock-in period 3 years. All that will not change at all. And if you don't do it, exemption will be withdrawn. That is 54D. 54D. Yes. Next, 54EC. 54EC. In 54EC, I will have to invest my amount in some bonds, government bonds, are redeemable after 5 years. What are those bonds? Rural Electrification Corporation Limited, RECL, National Highway Authority of India bonds, Power Finance Corporation Limited bonds, Indian Railway Finance Corporation, or any other bond notified by the central government. So, Raj Limited sells immobile property. Proceeds of the capital gains is invested in government bonds. Maximum investment is how much? 50 lakh rupees. That's it. And in all bonds put together, it's not per bond. People that also were doing. Here anything or was written, no, or. So what they did, they were issuing, I mean in 50 lakhs they were taking. Then they said singly or jointly they issued later. In the Bear Act it's given. So all bonds put together how much? 50 lakhs. Within 6 months you have to, and these bonds, no, there will be lock-in period of how many years? 5 years lock-in. Lock-in period, 5 years. If transferred, capital gains, whatever is exempt earlier will be withdrawn. Same, no change. 54 EC. 54 EE is useless because it is issued before 1/4/2019. You can leave it. 54F is similar to 54 but not similar also. Right? In what way? Here, there it was selling a house, buying a house. Here it is selling other than a house but buying a house. There it was individual HF, here also individual HF. There it was long-term capital gain, here also long-term capital gain. But there it was selling a house and buying a house, here it is selling other than house, but buying house only. This condition is the same. New asset within 1 year or 2 years out of the date of this thing, and construction within 3 years. New asset can be purchased within 1 year before or 2 years from the date of transfer. Everywhere you should have utilized the capital gain. Here you should utilize the net consideration, not capital gain. That is a big change. So there if it was 1 crore and cost was 50 lakhs, 50 lakhs you should have invested in a new house. Here 1 crore you should invest in a new house. If you don't do the full amount, then only proportionately it will be allowed. Lock-in period 3 years, and there are some additional conditions. The assessee should not own more than one residential house other than the new asset on the date of the transfer. Means he can hold one more, that's all. Maximum 2, including this. This cannot be the third house. This can be the second house. Assessee shall not purchase in a period of 2 years. Now, after this, gaining this exemption, tomorrow he cannot buy one more house. There's a lock-in there also. Within a period of 2 years after the date of transfer, but does not consider within 3 years. I already have one house. Can I claim under 54F? Yes. Then immediately after claiming nicely, next year one more house I'll buy. Not allowed. This house that I bought also should be locked in for 3 years, and no new house also can be bought for 3 years. So here peculiarly net consideration should be utilized. If net consideration is fully utilized, capital gain fully exempt. If only 80% of net consideration is utilized, 80% capital gain exempt. So this is one section where they have used the word net consideration and not capital gain. When you started commencement of construction is irrelevant, you should complete it within 3 years. Purchase of a residential house coupled with possession is a precondition. Registration is not at all necessary. And again in section 54, new house should be used by the assessee for own residence, nothing like that it's given. He can give it on rent also, no problem. If he buys 2 flats next to each other, what people do now, generally if there are 2 flats, they will say I want both, I'll remove all the walls and make it as 1 unit. So assessing officer said, is it 1 unit or 2 units? It is deemed to be 1 unit only. And one more interesting thing in section 54. Yes. In case where the amount of capital gain does not exceed 2 crore, the assessee may at his option purchase 2 residential houses with the same amount. This benefit shall be available once in the lifetime only. So generally I allow you only to buy 1 more, but in 54 they can allow you to buy 2 houses provided your full capital gain, not net consideration. Capital gain does not exceed 2 crore. In case of a building which is constructed for the sake of convenience, may consist of several units and could be capable of being converted into one residence as and when required. Yes, that also is the same. And deposit of capital gain as per the scheme is a procedural requirement. They say you should deposit within the due date. In case here and there you cannot deposit also, it's okay. Ultimately, if you deposit, if you show that you have deposited 10 days later also, assessing officer should say, okay, no problem. But what was the intention? You have used it only for that. So that delay is pardoned, is what they are trying to tell. Where a residential house is sold and capital gain is invested in constructing the first floor of another residential house already owned by the SSE. So I sell this house, and from that money I have one more house. On that I'll add one more floor. So they say exemption can be availed. Extension of house is also permitted. All these are court cases. They have clearly, intention is very clear. Intention is, okay boss, your same house you add one more, two houses you buy. The idea is not about two houses, one house. Idea is invest it in this purpose, for this purpose. Because that assessing officer, he said, no, this is not that house. You should buy another house. This fellow said, adding one floor is like a house only. This I was living there, my children will live. Two floors I'll construct. Or one floor only I'll construct, two separate partitions there. No, that's not another house. Then intention of law is supreme. Intention anyway, or by building a house only, no? Yes, yeah. Yeah, it's not necessary that the sale consideration should be realized for the purpose of investment. My sale consideration is 1 crore, cost is 40 lakhs, 60 lakh is the capital gain. Should I invest all 1 crore? No, except 54F. 60 lakh I'll invest in the house, 40 lakh I'll do some share market trading. Can I do that? Yes. That's what they're trying to tell. These are some of the examples. And 54B speaks about compulsory acquisition. Taxability will come based on what we have already discussed. Remember, initial compensation, enhanced compensation, all those things will be the same. That will not change. That will be the same. Can I claim more than one provision exemption? Yes, why not? Can I claim under 54 and 54 EC? Yes. Does that 54 and 54F cannot be combined and claimed together? Yes. Coming to the tax rates under capital gains. Tax rates under capital gains. 54F generally it's not allowed. No, because it's 54. In 54, this section was, this case happened in 54. So 54F, what you are doing, you are just selling any other asset and constructing a house. So yes, till now there is no such case, but if you do also, ultimately benefit is for that only, you can do that. Provided you don't own any other extra house. You can have only 2 homes including this. Because if you have a ground floor, it's like you are owning a house. And if you are adding one more floor to it, it's like the second house. Then you cannot have one more house somewhere else, is what they say. Yes. So, in 2018, Arun Jaitley told, earlier, if I sell capital gain, if I sell the shares, etc., it used to be fully exempt. Long-term capital gain used to be some normal tax rate, some normal thing used to be there. And in share market transaction, there used to be 20% tax, etc. But later there was fully exempt for like long-term capital assets. So if you held for more than 3 years, 1 year, 2 years as the case may be, and if you sold it, it used to be exempt. But in 2018, they removed the exemption under 1038. And they said now there will be a modest tax rate of 10%. 10%. So basically, that is as on 1/2/2018 onwards. there will be a tax rate of 10%. So you only tell me this is financial year is 1/4/2018. So if I say generally when the budget happens on 1st February, the applicability will go from 1st April. So if I am telling you 1st April you have to pay tax on shares. Till 1st April there is no tax on shares. Actually there is no tax on shares. What will you do? Start selling shares left, right, center. Stock market will crumble. So Arun Jaitley made a very smart move. He said, even if you sell during this time, what you will do, you would have acquired some 10 years ago for 10 lakhs. You are selling for 1 crore and 90 lakhs you are going tax free. Because my announcement is applicable from 1st April. What is the date today? Budget date? 1st February. 2 months you will left, right, center. 1 month, you will 2 months actually. Left, right, center you will sell and collapse the entire stock market. What he did brilliantly, he said, even if you sell during this period, I will make the cost of acquisition not 10 lakhs. I will make the cost of acquisition FMB as on 31st January 2018. I will only give you indexation there only and make it FMB. So you sell, you don't sell, your gain will not be, in this example, 90 lakhs. Your gain will be whatever you sell today minus yesterday's FMB. Hardly anything. Brilliant. Brilliant thing happened here, right? So 112A, equity shares, equity oriented fund, unit of business trust, 1 lakh exempt, more than 1 lakh, 10%. Sorry guys, 1 second, that call I have to take again. If there's any change, again we'll have to change. Sorry, 1 second. 2 minutes online people, sorry. Work call, nothing can be done, I have to take. As of now, there's no change, guys. 1 second. So yes, coming back, right. Now what happened? 112A inserted. 112A mein what all he told? Equity shares. If it is equity shares or equity oriented fund units or units of a business trust, these three things. What did he say? 1 lakh rupees, up to 1 lakh it is exempt. More than 1 lakh, how much is it? 10%. More than 1 lakh, 10% is the tax. And also what he did, FMB and all, he made it till 31st January. So if you are selling in the interim period, any time after that also, what will be it? 1st February. Sorry, 31st January will be the FMB cost. So he ignored, he ensured that all the old costs, etc., will be grandfathered. So that's a very good provision that came that time. Anyway, moving on. Yeah, so guys, tomorrow it is done, confirmed. We will take it at 11 a.m. Yeah, was shifted to October, 4th and 5th October. Right. Cool. 2nd October is holiday, no? Gandhi Jayanti. 4th and 5th. Okay, so this is it. Now, moving on, guys. Yes. Now, ultimately, what was the final uh, conclusion here also? It all that STT had to be paid. STT means security transaction tax. Now, for bonus shares, remember bonus we discussed. This is the scene. If the bonus is issued before 1st April 2001, then it is cost or FMV, whichever is higher. Cost or FMV, whichever is higher. This is before 1/4/2001. After 1/4/2001, 112A and non-112A cases. If it is non-112A, cost of acquisition will be nil. If it is a 112A case, means long-term capital gain on what? Shares, etc. Equity, shares or units listed plus STT, all that if it is there. If it is listed unit and STT is paid, then section 55, you will also get the FME benefit. What is FME benefit? That's what? As for 31st January, whatever FME was there, that will be taken as cost of acquisition. Will be taken as cost of acquisition. So, ultimately, if you want a combination of the tax rates, it will go to 112A, 111A, and other than 112A and 111A. What is 112A? Long-term capital gain. On what? These things. Equity shares, equity oriented units, and units of business trust. How much is it? 10% in excess of 1 lakh. And under 111A, short-term capital gain at 15%. Equity shares or equity oriented unit mutual funds, equity oriented funds, sorry, and units of business trust. Mandatory. It is mandatory. 111A is short-term capital gain. Other than 112 and 111A, that is what? Long-term capital gain. This is taxed at 20%. And short-term capital gains, normal tax rates. Then there is a proviso to 112. LTCG on listed security other than units and ZCB. For this, something extra. What is that? 10% without indexation or 20% with indexation, whichever is less. What is the example of LTCG on listed security other than units? Why other than units? Because all those things are covered where? In 112A. This is listed preference shares, equity shares on which STT is not paid. Like direct sale. For example, this guy, VG Siddhartha of Coffee Day, sold his entire holding in Mindtree to L&T Group, Larsen and Toubro. That was an off the share market deal. I didn't sell it from the share market. I directly sold it to you. I can sell it, why not? So that is equity share on which STT is not paid. So VG Siddhartha had to pay tax like this, 10% without indexation or 20% with indexation, whichever is less, obviously. Then listed preferences same, but all other listings etc. will come under this. LTCG 10% in excess of 1 lakh, 111A, STCG 15%. And also you will not get chapter 6A deduction against LTCG of 112, LTCG of 112A and STCG of 111A. You will not get the benefit. For example, if PGBP is 80,000, LTCG and STCG 112, 111A, 4 lakh 20, overall 5 lakh. Chapter 6A deduction, though I have spent 1 lakh 10,000, that is only available only to the extent of PGBP. Available only to the extent of PGBP. Why? Because there is no indexation benefit for LTCG and STCG. Why? Because LTCG under 112 and 111A rates are very less. Since rates are less, you will not get the chapter 6A benefit. Also, benefit of basic exemption limit also you will get after using it for other purposes only. Otherwise, you will not get. That is what it is. Joint development and all we saw. So finally, general rule under 45.1. Sorry. Under 45.1, what is the general rule? It is a year of transfer. But exception, you will get it in the year of taxability. What all? 45.1A, 45.2, 45.5 and 45.5. Indexation also, you will not get indexation in these cases. What? First proviso to section 48. What is that? Non-resident, TTBR and TTSR concept. Since I am taking everything to market value by taking the US dollar rates, etc., you will not get any compensation. Bonds and, sorry, no indexation. Bonds and debentures, no indexation. Section 50B, slum sale, no indexation. Goodwill, self-generated asset, etc., no indexation. Bonus shares, no indexation. 112A, no indexation. 112, option to take 10% without indexation. There also, you will obviously no indexation because you are taking 10%. LTCG on unlisted security in case of non-resident or foreign company, again 10% without indexation. And foreign taxation, again you will see in CA final that you leave. Yeah, LTCG, STCG basic exemption you will get, but after utilizing for others. So for example, in this, income from house property is 2 lakh 10. What is the deduction under chapter 6A? 40,000. So there, if you see, how much is it? 2 lakh 10 minus. What is the final deduction that you will get, guys, in chapter 6A deduction? How much can you take? In chapter 6A, how much can you take deduction? At ATC, for example, 1,50,000, right? So basically, you will only get, if you see here, basic exemption limit, 2 lakh 10 minus 40, you will get 1,70,000. What is the basic exemption limit? 2 lakh 50. So 2 lakh 50 minus 1 lakh 70, this 80,000. This 80,000 alone you can claim from LTCG or STCG. That depends on you. You have to be smart. Wherever the tax rate is higher, you can claim that this thing. So basic exemption limit, only the unexhausted portion can be claimed. Right? It can be claimed. Benefit of BL you will get, but only against the unexhausted portion. First you should give it to them and then others and then give it to LTCG. That's about it, guys. That's all. Capital gain is done. Again, a very important chapter. All right. So you guys need a break. We'll go eat something. No? Okay. So we'll continue because we'll finish since we have the time. We'll do IFOS after the break. Then tomorrow we can do TDS, important again, and that chiller chapter, salary. That is also important because many things you will forget there. So it's important to revise. Today we'll do IFOS. Let's take 10-minute breather and then we will do income from other sources. This is linked to capital gain in many ways. Why? Because an capital asset, if it is gifted to somebody, so gift is not a transfer, but gift again is what? Taxed under IFOS. So today we'll try to finish this. Let's see, and tomorrow we can do the remaining important areas and close it. That's it. Cool. 10 minutes, 10-15 minutes you can take. 241, right? 255, 255 we'll start. Maybe 45 minutes, 1 hour and close it. Okay. Online people, 255, 14 minutes. See you. All right. Income from other sources. So in IFOS, what does not go under any other head will go under IFOS. As simple as that. So first is 56,210, that is gift taxation. 56,210 gift taxation, it will come under this. What doesn't go anywhere will come here. So if any I give money, if any cash, a gift is given up to 50,000, no problem. If it is more than 50,000, 56,210A will come. Immovable property without consideration will be under 56,210BA, and inadequate consideration is 56,210B and capital B. Others, movable property without consideration, with consideration. We will see everything one by one. 56,210. So if any gift is given individually or together, all I have to add and I have to make it what? If it is more than 50,000, what to do? Less than 50,000, what to do? Is what we have to see. So if you see here, gift taxation, employer-employee relationship. Money, if any employer gives it to the employee, money, fully taxable. But if gift is given in kind, where a watch is given worth 6,000, 7,000, whatever it is, then that would be fully taxable. Business or profession, we saw there has to be a nexus because of related to work. Nexus, they have given some money, then PGBP will come. So if I have given a gift of my watch to my lawyer or chartered accountant for doing a good job, business connection is a nexus. Other gifts, in case of other gifts, then from 1st April 2017, all gifts are definitely taxed. Gift received by any person is taxed, subject to exceptions. So always taxed in the hands of the recipient or donee. So if you are, when I say other gift, I meant not in the employer-employee relationship and not in business or profession. Like casually, if you get any gift, definitely is taxable, subject to exceptions. But anyway, other gifts will be money, immovable property or movable property. Money, it is what? If aggregate money received is more than 50,000 rupees per annum. So mind you, each friend of yours gives 10,000 each. 6 friends are there. More than 50,000 is happening. Hence what? Taxable or not? Fully taxable. Immovable property will be land, building or both. Land, building or both. There is one is without consideration, one is inadequate consideration. Without consideration, if it is per property, and the stamp duty value is more than 50,000, then it is fully taxable. If it is inadequate consideration, so we'll just see movable first, then we'll come to immovable because movable is slightly easier. Movable property can be anything like shares, securities, jewelry, drawings, archaeological collection, painting, sculpture, work of art, bullion, whatever it is. Without consideration, with consideration. If it is without consideration, if aggregate FMB is more than 50,000 rupees, then it is fully taxable. So shares 20, art 40, jewelry 20, overall 80. Aggregate is more than 50, hence it is fully taxable. Inadequate consideration. If aggregate consideration, that is FMB minus consideration here, is more than 50,000, then difference is taxable. Like shares FMB 1 lakh, selling price 30,000. FMB minus consideration is it greater than 30,000? Yes. 1 lakh minus 30,000 is 70,000 greater than 50,000. Hence, the difference only is taxable. What is difference? 1 lakh minus 30. 70 lakh is taxable. Mind you, here also they have used the word aggregate. So I should keep on adding what all gifts I have got, and all gifts, if it is more, then only it will come. So as I told you here, shares, art, jewelry, 80,000. Aggregate is 80. So here also they have used the word aggregate. This is for movable property. But for immovable property, mind you, here the word aggregate is not there. Here per property. So immovable property means what? It will be land, building or both. Without consideration, if per property SDV is more than 50,000. If per property SDV is more than 50,000, then fully taxable. Fully taxable. If per property value is more than 50,000, fully taxable. Inadequate one, however, inadequate means what? 10 crore property was sold only for 1 crore. Then, if SDV is greater than 110% of consideration, this we have already seen. If SDV is more than 110% of consideration and SDV minus consideration should be more than 50,000 rupees. Both conditions must be satisfied. SDV must be more than 110% of consideration and SDV minus consideration must be more than 50k. Then the difference will be taxable. The difference will be taxable. So selling price 10 lakh, SDV 10 lakh 60,000. So if you see SDV minus consideration 50,000, that is 60,000 is more than 50,000. And SDV is greater than 110% of consideration. So SDV is 10 lakh 60, greater than 110% of consideration. What is 110% of consideration? What is consideration? 10 lakhs. So 110% will come up to 11 lakhs. So basically SDV is less than 11 lakh because SDV here is 10 lakh, SDV is 10 lakh 60,000. That is less than the consideration 11 lakhs. Since both the conditions are not, one condition is not satisfied. Here both should happen or what? Yes. If both conditions are satisfied, only then difference will be taxable. In this case, yes, SDV minus consideration is definitely more than 50k, but SDV is not more than 110% of consideration. So it's very, very less. Hence, SDV is less than 11 lakhs. So no tension. In this case, IFOS will not come. IFOS will come only both the conditions are satisfied. For example, a selling price is 50,000, SDV is 80,000. Difference only is less than 50k. Correct? 80 minus 50, how much? 30k. Difference is 30k. Will IFOS come? No. These are all the cases with respect to IFOS. Then, on the other hand, exceptions. No 56 to 10 in the following cases. On the occasion of marriage. On the occasion of marriage, because that is like life imprisonment is beginning. So the thing is, they say you take whatever you want, no tension. Nirmala aunty says you enjoy. You take however much you want money, I will not tax you. Anyway, full year, full life gone. Yes, that is on the occasion of marriage. Second is what? From a relative. So at least for that fellow being a relative, little bit use he should be. So if any money he makes, gives rather, that is not taxable. Now who is a relative? That same definition which we have seen. Same. Spouse, individual, that is their parents, lineal ascendant, lineal descendant, and all these things. Brother, sister. Their brother, sister, spouse is also covered. Individuals, brother, sister, and their spouse is also covered. Lineal ascendant, descendant, and their spouse are also covered. All these things are covered. Yeah. Then from HUF, right? HUF, for HUF, any member of the HUF is relative. Correct? So for a HUF, any member of HUF is a relative. But for member of HUF, is HUF a relative? No. So member of HUF gifting immovable property to the HUF is exempt. What is not exempt? HUF gifting immovable property to the member of HUF is not exempt. That is what it is. Then we'll see if there's anything else. Right. So instead of 110%, they have made it 120% for a residential unit sold during this time only. This is COVID amendment. 12/11/2022, 36/2021. And the consideration maximum should be only 2 CR. The consideration is 2 crore. Then yes, 12/11/2022, 36/2021, whatever you did that transfer, then your threshold will be what? 110. Instead of 110, it will be 120%. First time allotment of residential unit, it should not be any reselling. Similar amendment they made to 56.210 also, same thing. 56.210, you will get a 120% benefit under 43 CA and 56.210. This is for predominantly only for a builder, mind you. It is only for a builder, not for anything else. So this amendment comes only for 43 CA cases, that is PGBP cases. It will not come for, like if you had a house, you are not taking it as stock in trade. You have a house for, as a capital asset. You are selling it during this time. It will not come. For 50C, that is a normal person selling, this benefit will not come. This will only come for 43 CA cases. And 43 CA is what? It is only for PGBP cases. Only for PGBP cases. Next concept is dividend. So this is all. That's all there is to it here. In this, nothing great. Yeah. Only thing is, let's see gift taxation how it works first before going to dividend. Gift taxation, an example we'll take. So Miss Sita, this is combination of capital gain and gift. Miss Sita sells her house on 14/11/2021 to Mr. Kunal. Cost of acquisition for Geeta was 4 lakhs and she had acquired it in previous year 1-2. Mr. Kunal, now selling price is 40 lakhs, SDV is 45 lakhs. So Miss Sita has sold it to Mr. Kunal, selling price 40 lakhs and SDV is 45 lakhs. Sells it on 14/11/21. What is the cost of acquisition? 4 lakh. Acquired in which year? Previous year 1-2. Mr. Kunal now sells it to Mr. Adi. Mr. Kunal sells it to Miss Adi. Mr. Adi. Selling price is how much? 84 lakh. Selling price is 84 lakh. When does the sale happen? 12/3/2022. 12/3/2022. Now, capital gains in the hands of Miss Sita. Capital gains in the hands of Miss Sita. Full value of consideration is 45 lakh. Why? 110% of selling price is 40 lakhs. How much did I sell it for? 40. So his selling price and 110% of consideration comes to 44. So selling price is definitely, what do you say, less than 110% of consideration. So what will be the FPOC? FPOC will be the SDV. What is SDV? 45 lakhs. Minus index cost of acquisition. How much? 4 lakh into obviously 317. It's sold in, let's say, 14/11/21. So for 21/22 it was 317. 317 divided by 100. So overall it's how much? 12,68,000. So what is the LTCG? 32,32,000 will be the LTCG. Period of holding was from 1-2 to 14/11/21. That's done. Next. Kunal now sells it to Mr. Adi. Now, this was sale. But you see, gift taxation. So in the hands of Mr. Kunal. How much did he purchase it for? 40 lakh. But how much was the SDV? 45 lakh. Right? So as per 56/210, what is the dialogue? Is it an immovable property sale? Yes. Is it, what do you say? The difference, is it more than 50,000? Yes. 45 minus 40. Next, is the SDV greater than 110% of selling price? You see, first one 45 lakh minus 40, 5 lakh. 5 lakh is more than 50,000. Condition 1 satisfied. Second one is SDV greater than 110% of selling price. Yes, selling price is 40. 110% is 44 lakh. SDV 45 lakh is greater than 44 lakh. Hence, under gift taxation, difference is taxable. So, here Kunal also has to pay on 5 lakh. If you see, Sita also has paid on 45 lakh instead of 40. Kunal also is paying on 5 lakh. So can I say gift taxation leads to double taxation? Yes. Gift taxation definitely leads to double taxation, no doubt about it. So anyway, so in that year, how much should this guy Kunal pay? 45 lakh minus 40 lakh. On 5 lakh he has to pay. Now, Kunal sells it to Mr. Adi for 84 lakhs. Kunal sells it to Adi. Gift taxation in the hands of Mr. Kunal, capital gains in the hands of Mr. Kunal. So, what is the full value of consideration? 84 lakh. Minus cost of acquisition. What is the cost of acquisition? Since I have already paid tax on 45 lakh, I can take my cost as 45 lakh. Short-term capital gain, 39 lakh. Why is it short-term capital gain? Because the period of holding is only from 14/11/21 to 12/3/22. So, short-term capital gain is 39 lakh. In the same example, instead of this, if Sita had gifted the property to Mr. Kunal, if Miss Sita had gifted the property to Mr. Kunal, what would happen then? Then capital gains in the hands of Miss Sita, it is not a transfer. It is not a transfer under section 47. No capital gains for Miss Sita. But this Mr. Kunal is taking the gift, right? As per 56(2)(10. Is he getting for free? Yes. Is it more than 50,000? Yes. Is he a relative? No. So full 45 lakhs is taxable. Other things remain the same. But you see, gift taxes in the hands of Mr. Kunal, capital gains in the hands of Mr. Kunal, 84 lakh minus 45 lakh, 39 lakh. However, if Miss Sita and Mr. Kunal were relatives, then 56(2)(10 also is not applicable. Then cost of acquisition will be the previous owner will be considered. Period of holding also of the previous owner will be considered. So capital gains in the hands of Miss Sita won't come. Capital gains in the hands of Mr. Kunal will be what? Full value of consideration 84 lakh minus index cost of acquisition 4 lakh into 317/100. 12,68,000. So what is the long term capital gain? 71,32,000. Correct? That was that. $71,32,000. Done, guys. So next, what is there? This 120% visa only for builders, mind you, only for builders, nobody else. Online people, are you there? Yes. So all this. Now comes the dividend portion. Dividend. So let's see. Dividend is what? Return on investment. Dividend is return on investment. You have two types of dividend. One is interim dividend, one more is final dividend. Interim dividend recommended and declared by board of directors under 123(3). Final dividend recommended by board, declared by shareholders. So all that is fine. Dividend taxation. Earlier, dividend paid. There was something called corporate dividend tax to be paid by the companies under 1150. Since they already would have paid tax, that amount was fully exempt for whom? For shareholders under 1034. So for shareholders it was exempt, but for companies corporate dividend tax was paid. But then a few years ago they changed the law whereby for companies anyway it's like an appropriation, and who should pay the tax? Shareholders. So since shareholders were not interested in paying tax, the company started giving them dividend in other forms like distribution of assets. So since that was cheating, the government decided to tax that also under the concept of deemed dividend under 222. 222 will start from A, B, C, D, E and all these things. So what does the law say here? Any domestic company distributes all or any part of the assets of the company to its shareholders to the extent of accumulated profits, whether it is capitalized or not, it shall be taxable as dividend in the hands of the shareholders. If any domestic company distributes all or any of the part of the assets to its shareholders to the extent of only what? Accumulated profits. Because obviously can only give you assets worth of accumulated profits. Other things will be in the capital anyway. Whether capitalized or not, means whether you take it as bonus or not bonus, I don't care, shall be taxable as dividend in the hands of the shareholders. It may be noted that accumulated profits are distributed to the shareholder in the form of cash. Equivalent sum shall be deemed to be the dividend in the hands of the shareholder. On the other hand, if it is done in kind, then FMB of the asset shall be deemed to be the dividend in the hands of the shareholder. Accumulated profits of the company are 14 lakh. Book value of asset 8 lakh, FMB 16 lakh. Deemed dividend will be to the extent of accumulated profit only 14 lakh. Why? Because only to the extent of accumulated profit. FMB, even though if it is higher, I don't care. Next, book value is 8 lakh, FMB is 11 lakh. Deemed dividend also to the extent of accumulated profit or FMB, whichever is less. So your FMB only is less. FMB will be deemed dividend. Here both are 14. So obviously I should take it at 14 lakhs only. It's 222A. 222B is what? Distribution not entailing the reserves of assets, but I will give him what? Debenture stock certificate, preference shares and all those things. To preference shareholders, I will give bonus shares, which generally is not given to them. I will give it to them like that indirectly. Or to shareholders, I will give debentures, debenture stock, deposit certificate, etc. So there also same thing, to the extent of accumulated profits, capitalized or not, deemed dividend. 222C, in case of liquidation, company going for liquidation, it shall be treated as deemed dividend in the hands of the shareholder to the extent of accumulated profits immediately before its liquidation, whether capitalized or not. That is 222C. So here it was distribution in case of liquidation. Any distribution, let's say, that is cash, assets or cash plus assets, only given to whom? Equity shareholders. As on which date I should see? On the date of commencement of liquidation is what I need to check. So if the company on liquidation is distributing assets, under 46(1), there is no tax for the company because it is not a transfer, no capital gain for the company. But for the people who is receiving, what will come? 222C. Shareholder will have to take cash. If it's assets being distributed, because if you see here, if a distribution of assets is made, if only assets is made, 222C will come. If it is cash, etc., then same section 46(2). Number will change, but the concept remains the same. That is what it is. In more in depth, you have seen in regular batch that you leave. 222D is what? Reduction of capital. Any distribution by a domestic company to its shareholders on account of reduction of share capital with the extent of accumulated profits of the company, whether capitalized or not, shall be taxable in the hands of shareholders as deemed dividend. This is reduction of share capital. When I am reducing the share capital because of internal reconstruction, any distribution of assets that I make, that also will be deemed to be dividend. That is also deemed to be dividend. 222D. So if I give anything, any distribution in case of internal reconstruction, so every single money will be taxed in the hands of the shareholder undoubtedly. So 222A was asset, 222B was debenture for others and bonus for preference shareholders. 222C was liquidation, any asset. Because if it was cash, it is under 46.1 and 46.2. 222D is again any asset in the form of what? Reduction of share capital. But 222E is slightly different. In 222E, under section 185 of Companies Act, company cannot give loan to director. Similarly, in 186, apart from director to others can it give? Yes, but we need certain permissions. So in 222E, what happens? Any payment to the extent of accumulated profits by a closely held company in the nature of any loan or advance to a shareholder. So one is loans to directors. Then what if I give loan to shareholder? Some shareholder is there who happens to be the director's relative. If I directly give loan to director not allowed, so what will I give? I will give it to the relative. If those things are happening, then it is also deemed dividend. Deemed dividend. So anything. And moreover, you should have substantial interest. So first of all, closely held company should be giving loan or advance to the shareholder, 222E will come. Or it is giving to a concern in which the shareholder has substantial interest. What is substantial interest? 20%. And what is this concern? Firm, HUF, AOP, BOI company, whatever. And the closely held company is giving what? Loan or advance to this particular concern. It is also deemed dividend. So all these things will be called as deemed dividend. So if a closely held company is in the business of lending, then no problem. If the closely held company is not in the business of lending, still it will give it as loan to its shareholder, then deemed dividend will come under 222E. Then as far as buyback of shares is concerned, in the hands of the company, in the hands of the shareholder, mind you, buyback 1034A, no tax treatment. Under 1034A, no tax treatment. But in the hands of the company, 115 QA will come. That is buyback price minus issue price. Buyback price minus issue price. Tax paid at what rate? 23.296%. 23.296% is the tax that is paid, or 20% tax plus 12% surcharge plus 4% cess. When? Within 14 days from the date of buyback. Within 14 days from the date of buyback is what you need to do. You need to pay this. So gift done, dividend done. So even mutual, any return from UTI mutual funds are also taxable. Income of member of parliament, MLA, MLC. Salary will be under IFOS. Daily allowance or constituency allowance is exempt under 1017. Any awards you receive from government like Bharat Ratna, Padma Bhushan, Khel Ratna, exempt under 1017A. Other awards taxable under IFOS. Winning from lottery, crossword puzzle, general game shows, horse race, IFOS. Tax rate 30%. Agricultural income from land in India, exempt under 10(1). From land outside India, IFOS. Rental income from house property, income from house property. Rent of asset other than house property, if I am renting you two-wheeler, etc., IFOS. Composite rent, that is agreement is not separable, composite, then it also IFOS. Subletting is also IFOS. Royalty on books, if I am getting, that is also IFOS. Director we saw remuneration if he's employed plus salary if he's getting, and consultancy etc. PGBP. Sitting fee for board meetings, it is IFOS. And if you are an ICI, invigilator, paper setter, evaluator, etc., IFOS. If you are a paper setter for school, then you will be just be employed. CMA insurance policy received by employer, PGBP. Amount received by employee, salary. Amount received by any other person, chairman emeritus, IFOS, it will be IFOS. Maturity amount of life insurance policy, which is exempt under 10(10)(d), generally except maturity amount received by key managerial personnel that we have seen. Family pension is taxable to the extent of 1/3 of family pension or 15,000 rupees per annum, whichever is less. That's also done. Any gallantry award also again will be generally exempt, but interest received from gold bonds 1999, gold monetization scheme 2015, and PPF etc. fully exempt. Interest on late compensation on compulsory acquisition of property, we have seen that taxable interest is 50% will be taxable. Any other interest is taxable. Post office savings account exempt up to 3,500 rupees per annum. Joint account 7,000 rupees per annum. Advance forfeited on or after 1/4/2014 we have seen as per 5629 taxable. Compensation received on termination or modification of employment from non-employer organization, that is also what taxable under this. That is also taxable. Then under 57, allowability of expenditure. How much is allowed? Rent when I am earning something. Expense, is it fully allowed? Yes. For example, rent paid is 60,000, subletting is 70,000. So 60,000 rent paid allowed? Yes. So what is your income from other sources? 10,000. Exempt income. For exempt income like agricultural income, expenses will not be allowed. For winnings from lottery etc., expenses will not be allowed. Interest from late compensation that you are getting, 50% is allowed. Dividend income from UTI, income from mutual funds etc., only interest, and that too up to 20% of dividend income. This is if I have taken a loan to invest in share capital. If I have taken a loan to invest in shares of some company, whatever dividend I will get, can I subtract the interest that on loan that I am paying? It says only interest expenditure, and that too up to 20% of the dividend income or income from mutual fund UTI will be exempt, will be taken as a deduction. That's, for example, if loan is 1 crore, interest rate 15%, what is the interest per annum? 15 lakh. Dividend income is 12 lakhs. 20% of 20% of dividend, 20% of 12 lakh, 2.4 lakhs. So I can claim only 2.4 lakh. IFOS will be 12 lakh minus 2.4 lakh, 9.6 lakh. Following expenses will never be allowed. Personal expenditure, interest, salary paid outside India on which TDS is not deducted or deducted but not paid. Any expenditure paid to resident person, if TDS is not deducted, then 30% is disallowed. Cash expenditure of more than 10,000 a single day to a person. Again, what the expenses are not allowed, we have seen. Expenditure related to casual income, that is winnings, not allowed. 40A2, that is relative, that is also not allowed. Excessive expenditure is not allowed. That's all. That is about IFOS. Very, very simple. So in tomorrow's session, we will do salary and TDS. That is also very important, TDS. So we will do that and close it. Other things you can go clubbing and all, you can check, guys. It's very easy. Clubbing, I have released a video clip, animated video clip. You can see, you will understand everything there. Then other things, reductions and all are very easy. ATC, ATD, study that and go. But two important areas, salary guarantee questions will come. Lot of things are there in salary, and of course in TDS also minimum 3 to 4 marks. So salary TDS again put together around 10 marks easily you can get. So tomorrow we'll cover that part. Every day we are covering around 10 to 15 marks. That out of your 60, at least 40, 45, if we cover those revision sessions, remaining 15 you can study on your own, which is like easy. Okay, cool. So see you tomorrow, guys, 11 a.m. Okay, 11 will start and wind up by lunchtime, no problem. Online people, see you at 11 a.m. tomorrow. See you. Bye.